Hello learners, welcome to our today's session of Revision Management Accounting December sitting. In our previous class, we were looking at question number 2, and today we are looking at question number 3 of the same sitting. So welcome, have your calculator. Let's walk through together. Question number 3, part A, reads as follows. The cost accountant of ABC Limited has provided the following information relating to production of a single product branded Z. So we've been given details for 3 periods, that's period 1, 2, and 3. We have production in kilograms, sales in kilograms, opening stock in kilograms, and closing stock in kilograms. Then additional information note number 1, the financial details for 1 unit of Z based on the normal activity level of 30 kilograms are as follows. So we have the cost per unit for direct materials, labor, production overheads, and the selling price per unit. Then note number 3, we are told that administrative overheads are fixed at 25,000 per period, whereas 1/3 of production overheads are fixed. And then required, prepare operating statements using Roman 1 variable costing. So we want to begin from there. Roman number 1, variable costing. So in management accounting, we have 2 methods of costing that we use, and one is a variable, or what's called marginal costing, and then the other one is called absorption costing. So in variable costing or marginal costing, we normally include variable costs only in the cost of sales. So when we are computing the cost of sales, ensure that we are separating the fixed cost and the variable cost, so that we only consider the variable production cost. And that's what we are required to do. And since we have 3 periods, we need to show all the periods on one sheet. So we'll not prepare for period 1, 2, and 3 separately, but to show it as one statement. So you can prepare that. So this is ABC Limited variable costing income or operating statement. Variable costing operating statement. So we were not given the year. If we had at the year, then we say for the year ended, but we do not have that. So we all have that included. So we have period 1, period 2, and period 3. So for each period, we'll have 2 columns. So we have 3 periods, which will show it all together. And so we begin with the sales. So we normally have the format for preparing the operating statement. We'll have the sales, we less the cost of sales, we less the closing stock, the cost of sales, we less the fixed cost, and we'll be able to get the net profit. So we calculate the sales. We are beginning with the period 1. Period 1 sales were 30,000, and in note number 2, we are told that the selling price of product Z is 9 shillings per kilogram. So to calculate the sales, we are taking 30,000 multiplied by the selling price of 9, which will give us 270,000. can put in thousands of shillings so that we have smaller figures. So we have 270 as the sales for period 1. Then we less cost of sales. So cost of sales comprise the opening stock. When you look at the question, period number 1, we were told production was 30,000, sales was 30. And then we do not have any information about the beginning inventory. So we assume that there was no opening stock. So you just put a nil where we have opening stock. Then we add production cost. Production cost will comprise variable production cost only. So the main variable production cost as given in the question is we have direct materials. We were told that it is 1.5 shillings per kilogram. So when we are calculating the variable costs, we base on production. So we take 1.5 multiplied by 30,000. 1.5 times 30,000 kilograms, and that will give us 45,000. We also have direct labor. We have direct labor, which was 1 shilling per kilogram, and production was 30. So 1 shilling multiplied by 30 will give us 30 shillings. 30,000 shillings. Then the next one is production overhead. Production overheads. So the production overheads that we are including are the variable production overheads only. In note number 3, we were told that the administrative overheads are fixed at 25,000 shillings per period, whereas 1/3 of production overheads are fixed. So meaning the 3/4 of the production overheads is variable. So we are to get that variable part, and that's what we will include in the cost of sales for that variable statement. So how do we calculate that? So working 1, we are calculating the variable production overheads, which is simply variable 2/3 of 3 shillings. A third is fixed, so means 2/3 is variable. So we multiply by 3 shillings, and this will give us 2 shillings. So to calculate the variable production overhead, this is our working number 1. Working number 1, we are taking 2 and we are multiplying by the production. So the production was 30,000 times 2, and that will give us 60. So we take 60, and then we add this. This gives us 135. Before we bring it here, this will give us 135, and this is the cost of goods available for sale. Then we less closing stock. So we were told that production was 30,000, sales were 30,000, meaning there was no closing stock. So we have nil stock, and therefore the amount will simply be 130, which is our cost of sales, and then we subtract it from the sales to give us what we refer to as contribution. So contribution is simply sales minus the cost of sales. So when you subtract this, you'll get 135. And once we get the contribution, we less all the fixed costs. So in variable costing, whether it is a production fixed cost or a non-production fixed cost, we subtract it from the contribution. So we are to identify the fixed cost in the question, and we'll calculate the fixed. This is two fixed production overheads, which we were told that was 1/3 of that which was given, and this is simply 1 shilling. So we have fixed cost under which we have production overheads, and this is 1 multiplied by the production. Production was 30,000 multiplied by 1, and that will simply give us 30,000. We also have administrative overheads, fixed administrative. The administrative overheads are fixed at 25. So you add that, this will give us 55, and we subtract it so that we get the net profit. So the net profit will be 80. That's for period 1. We do the same for period 2 and 3. We do the same for period 2 and 3. So for period 2, the sales, we need to calculate the sales, which we are basing on the sales in kilograms times the selling price. So the sales in kilograms were 27,000 multiplied by 9 shillings. So this will give us 243,000. Then we are lessing the cost of sales under which we have opening stock. So we need to know whether there is opening stock. In period number 2, the production was 38,000. The sales were 27,000. So when you take 38,000, remember we do not have any closing stock from period 1. So when we have closing stock in period 1, this closing stock will automatically be the opening stock in the next period. So that simply means in period 2, we do not have opening stock. Why? We do not have closing stock from period 1. So for opening stock in period 2, we also put a 0. And I was explaining we had 38,000 units produced, and we are told that 27 was sold, and then we have 11,000 remaining in stock, meaning there was no opening stock. From there, we add production cost. So production cost comprises direct materials. We are including variable cost only. So direct materials for period 2, we are taking 1.5 shillings. That was the cost per unit, and we multiply by production of 38,000. And this will give us 57,000 shillings. Then direct labor is given at 1 shilling per kilogram. So we take 1 multiplied by production of 38. 1 times 38, we will have 38,000. And then production overheads for period 2, we were told that variable production were 2/3. Still working number 1, 2/3, which gave us 2 shillings per kilograms. So 2 shillings multiplied by 38,000. 2 times 38,000 will give us 76. And then we add. So the total is 171. And in period number 2, we are told that we have a closing stock of 11,000. So we need to calculate the closing stock value. This is working number 3, closing stock. Closing stock, this will simply be based on variable cost only. So we were told that closing stock, that is for period 2. Period 2. We have 11,000 units times. So the question is, what is the cost per unit? The question per unit, the cost per unit will comprise the cost per unit of direct material, the cost per unit of direct labor, and the cost per unit of production overheads, which we've already been given in the question. So we are taking 1.5, which is the cost per unit for direct materials, plus 1, this is 1.5, plus 1, that's the cost for direct labor, plus 2, which is the cost for production overheads. And what we get will be the value that we will use in period 2. So 1.5 plus 1 plus 2 will give us 4.5 times 11,000, and this is 49,500. So our closing stock here is 49.5. Subtract that. And this will give us 121.5. So 121.5 is the cost of sales, which we subtract from the sales. And this will give us 121.5. Then we come to fixed costs. The fixed costs, we say that was 1/3. Fixed production overheads, 1/3 of 3 shillings, which is 1. So we take 1 and then we multiply by the production. And production for period 2 is 38. So the fixed production overhead here is 38,000, and fixed administrative overhead remains fixed at 25. So add that, and this will give us 63. We subtract it from the contribution and we'll get a profit of 58,500. That's for period 2. Then we move on to period 3. In period 2, we had closing stock of 49.5. So this closing stock will automatically become the opening stock for this period. So for opening stock, we have 40. Sorry, we've not calculated the sales. We begin from sales. So the sales for period 3, according to the question, production was 27,000 and sales were 38. So take 38,000 times the selling price of 9 shillings, which will give us 342,000. And then we less cost of sales, of which we have the opening stock. So the opening stock is here. Here is 49.5. This is the balance to be carried forward, which was 49.5. So we bring it there. Then we add production cost, and production cost is comprising direct materials. And the direct material cost per unit is 1.5, but production was 27. So take 1.5 times 27,000, it will give you the cost for direct material, which is 40.5. That's 40,500. Then direct labor is 1 shilling per kilogram. Production was 27. So 1 times 27,000 will give you 27,000. We come to production overheads, working number 1. It was 2/3 of 3, which is 2. We take 2, we multiply by production, which was 27. So 27 times 2 will give us 54,000. And then we add that. So this will be equal to 171. Then 171, we see whether there is closing stock. In the question, we do not have opening stock. Production was 27,000. The sales were 38,000. So when you take the sales of 38,000 and then you subtract it from the 27,000 production, you'll realize that there was a deficit of 11, which was just the balance that was carried forward from the closing stock. So there is no closing stock in period 3. So we subtract a 0, we subtract a 0, which will give us 171. We subtract 171 from the sales, and it will give us 171. Then we less the production overheads. Production overhead, working number 2. Production overheads, working number 2. Working number 2, we have 1 shilling times production of 27, and this will give us 27. Then administrative overheads are fixed at 25. So we add that, and this will give us 52 shillings, which we then subtract from 171 to get a net profit of 119. And that's how we use variable. So a point to remember, in variable, we are including variable production cost only. When we compute inventories or stocks, we use variable production cost per unit only. We don't include any fixed portion. And that was Roman 1. Then we move on to Roman number 2. So Roman 2, we use absorption costing. So the company is ABC Limited. So we begin with the sales. So how is absorption costing different from marginal costing? We have 3 main things that differentiate between marginal and absorption. In marginal, we have said we are separating fixed cost and variable cost, so that what is included in the cost of sales is only variable. In absorption costing, the cost of sales will comprise both fixed and variable components. So long as it is a production cost, we consider it both as fixed and variable. Again, in absorption costing, we have what we refer to as product cost and period cost. Product costs are treated, in absorption costing, we treat fixed costs as product costs. But in marginal costing or variable costing, we are treating fixed costs as period cost when we expense them when they are incurred and in that period in which they are incurred. And the last item that differentiates between variable and absorption, in variable we do not have application of absorption of overheads, but in absorption costing we have application of the principles of absorbing cost, which is making it different. So we begin with the sales. The sales are calculated in the same way. So for period number 1, we have sales of 30,000 and the selling price is 9. So when you take 9 and multiply by 30,000, we get 270. Then we less cost of sales. So the cost of sales will comprise opening stock. So we didn't have opening stock in period 1, so we put a 0. Then we add production cost. Production cost consists of direct materials. So the direct materials for period number 1 is 30 times 1.5, which gave us 45,000. We add direct labor, and direct labor was 1 shilling per kilogram, and we had production of 30, which is 1 times 30, and that's 30. Then production overheads. So when we come to production overheads, we are not separating fixed and variable. In the question, we were told that production overheads was 300% of labor, and that the amount is 3. And in note number 3, we were told that administrative overheads are fixed at 25,000 per period, whereas a third of production overheads were fixed. So in marginal or variable, we were separating that. But in absorption, we don't separate. Why? So long as it's the production cost, whether fixed or variable, we include it in the cost of sales. And therefore, to calculate production overhead, we are simply taking 3 and we multiply by the production, which is 3 times, this is workings, 1. We are taking, this is production overheads. This will simply be 3 shillings times 30,000 kilograms, and that will give us 90,000. So we will have 90,000 and not 60 as in the case of variable. Then we add so we have 165. We have 165, which is the cost of goods available for sale. Then we less closing stock. Closing stock in absorption costing is based again on both fixed and variable, but according to the question, there was no opening stock. So there was no closing stock, so it is 0. We subtract that and we get 165, which is the cost of sales. When we subtract, we now get what we refer to as gross profit and not contribution. So the gross profit will be 105, and once we get the gross profit, we will consider whether there is any over or under. So we add over absorption. Over absorption arises when what we absorb or what we charge is more than what is actually incurred. So when you read note number 1, we were told that the financial details of one unit of product Z based on a normal activity level of 30,000 kilograms. So it means the details we have were based on the activity level of 30,000. So whenever a company produces either more or less than that, it means there will be either an over or under absorption. But in period number 1, we will not have an over or under. Why? This farm produced 30,000, which is equal to the normal level of activity. So for overabsorption, there is a nil, and then under absorption will also give us a nil. So this is subtracted, overabsorption is added, under absorption is subtracted to give us the adjusted gross profit. So our adjusted gross profit is 105, and from there we less all the expenses. So in management accounting, expenses are simply referring to all the non-manufacturing costs. Any non-manufacturing cost is considered as an expense. So according to the question, in note number 3, we were told that administrative overheads are fixed at 25,000. So our expenses here are simply the administrative overheads, and is fixed at 25. So you subtract that, and what we get will be the profit, which is 80,000. That was for period 1. We do the same for period 2. The sales remains the same. Sales made were 27,000. 27,000 times 9 gave us 243. Then opening stock, since we do not have closing stock in period 1, opening stock is not, will not be there. We add production cost, which is comprising direct materials. So direct materials were 38 times 1.5, which gave us 57. Direct labor was 38,000 times 1, which gave us 38. And then we need to calculate production overheads. This is working number 2. So production overheads was working number 1, and then still working number 1, production overheads now for period 2. Period 2, we are using the same formula. We are simply taking 3 multiplied by the production units, in this case, which were 38,000 kilograms. So 3 times 38,000 will give us 114. So production here will be 114. And then we add. This will give us a total of 209. So something to note is the production overhead is 114, and the production was more than that of the normal activity level. We were told that this data provided is based on the level of 30,000. And so if we were to rate the actual amount should have been 90,000, which is based on the activity level of 30,000. But now here we have 114,000, which is above that. So it means that we will have an overabsorption. Why? What we are absorbing or what we are charging The 114 is greater than what should have been charged under the normal, which is 90. So when we are absorbing more than that which is actual, then we have an over absorption. Of how much? Of simply the difference. So we show the over absorption of overheads, which will be equal to 114,000 minus that of the actual activity, which is 90,000. So this difference and this will be 24,000. So we will adjust that on our profit. So we now have the cost of goods sold, which is 209. Then we see if there is any opening closing stock. We were told that closing stock was 11,000. So how do we calculate closing stock? So closing stock will be based on all the production cost, both fixed and variable. And so in this case, closing stock will now be 11,000 multiplied by the cost of direct material plus that of labor plus that of the production, both fixed and variable. So when you calculate that, this will give us 60,500. So the closing stock will be 60,500. This will be 60,500. We subtract that and then we get the cost of sales, which is 148.5. Subtract the cost of sales from the sales to get gross profit of 94.5 or 94,500. Then we check if there was an over absorption. There was an over absorption of 24,000. So we add 24,000. There was no under absorption. And then we get the adjusted profit. So this will give us 118.5. Then we less expenses, which are just the 25,000. Then this will give us a profit of 93.5. 93.5. We move on to the last period. That's period number 3. The sales are remaining the same. That is 342. Then we add, we less cost of sales, of which we have opening stock. So in period 3, we will have opening stock. Why? Because we had closing stock in period 2. So opening stock will be 60.5. Then we add production cost, which is comprising direct materials. The direct materials is production 27,000 times 1.5. Which gave us 40.5 or 40,500. Then we add direct labor. That's 1 shilling times 27, and that gave 27. And then we calculate production overheads. So production overheads for period 3. Period 3 production overhead. Period 3 production overheads. This will be equal to 3 shillings times 27,000. And this will amount to 81. So for the normal activity level of 30, the Production overheads were 90. So the actual production overheads are 90, but now what we are absorbing is less than that which is actual. So when the absorbed is less than the actual, it means that we have an under absorption of overheads. And under absorption is the difference, which is 90,000 minus 81,000. So this will give us 9,000 shillings. So we will use that again to adjust our gross profit. So we add this. This will give us 128. There was no closing stock in period 3. So we have nil closing stock. And so we'll have 128 cost of sales. We subtract the cost of sales from the sales, and this will give us 214,000. So we do not have over absorption, but we have an under absorption of 9,000, which we subtract, and then we remain with 205,000. So 205 less expenses of 25,000 will remain with, so the profit will be 180,000. And that was part A of question number 3. We now move on to part B of the same question. Summarize 4 assumptions of cost volume profit analysis. Assumptions of cost volume profit analysis. So cost volume profit analysis is comprising 3 variables. We have one variable cost, another one is volume, and the other one is profit. So in cost volume analysis, we are looking at when one variable is changed, what will happen to the other variable? Are fixed costs remaining constant? What will be the effect on the revenue, and so on? So what are the assumptions? Assumption number 1, we say that total costs can be separated into their fixed and variable components. This is question 2, part B. 2, volume is the only factor affecting sales and expenses. Number 3, the theory of cost volume profit analysis. The theory of cost volume profit analysis applies to only a single product. Applies to a single product, only applies to a single product or service only. Then number 4, the selling price per unit, variable cost per unit, and fixed cost remains constant. I can add one. There is only a single product, there is only a single product or service and in case of more than one, then a product mix will be applied. So those are some of the assumptions of cost volume profit analysis. Number one, we are saying that total costs can be separated into their fixed and variable components. So whenever you are given a total cost, we normally say that total cost equals fixed costs plus variable cost, so that given a total cost and a proportion of either fixed or variable, we can be able to separate them. Then two, volume is the only factor that is affecting sales and expenses. So when we change, we assume that in a cost volume profit analysis, whenever we change volume, there will be a change in sales that will bring about a change in expenses. So we say that the only factor that is affecting either sales or expenses is volume, and that happens when volume is changed, whether either being increased or decreased. And then the theory of cost volume profit analysis applies to a single product or service only. So it is not applied where we have more than one product. So in the last part, we have said that if there is only one product, we are assuming that cost volume is being applied where we only have one product or service. And in case we have more than one product, then we must have a product mix being applied, but it cannot be applied where there is more than one product. And again, we assume that the selling price per unit, the variable cost per unit, and fixed cost per unit remain constant. And we assume from 0 capacity to 100, especially in the case of fixed costs, they do not change. That was part B. Then lastly, we move on to part C. We are told that Britain Limited makes a single product branded P with a sales price of 100 shillings and a variable cost of 60 shillings, full stop. Fixed costs are 600,000 per annum. They are required, assuming the taxation rate is 40%, determine the number of units to be sold to make a profit after tax of 200,000 shillings per year. So assuming taxation, you have to ask yourself, what are you being asked to calculate? You are simply being asked to calculate in Roman 1, part C, Roman 1, you are being asked to calculate the level of sales to realize a target profit after tax, and that is in units. Level of sales to realize a target profit of after tax. So you've already been given the target profit, you have the tax. So how do we calculate this? This is the formula that we will use. We will have fixed costs plus target profit And this target profit is to be exposed to tax. So we take 1 minus tax, or T, and then we divide the whole of this by CM. CM is simply contribution margin. So we calculate that. We were told that the annual fixed costs are 600,000 plus the target profit assumed is 200,000. We divide this by 1 minus tax, and the tax rate given is 40%, which is the same as 0.4. We divide the whole of this by contribution margin, and contribution margin is simply the sales price, which is 100 shillings, minus minus the variable cost per unit of 60 shillings. So we normally refer to this as CM, which is simply the selling price per unit minus the variable cost per unit. So we calculate this. So this will give us 23,333 units. So that's the level of sales that you will need to sell for you to realize a target profit of 200,000. Then Roman 2, we are told that as a result of increasing costs, the variable cost is expected to rise to 65. So it is rising from 60 to 65 shillings per unit, and the fixed cost to 700,000 shillings per annum. So we are told that assuming the selling price cannot be increased, determine the number of units required to maintain a profit of 200,000 shillings per annum. So we are told to ignore inflation. So in other words, we are to calculate, determine the level of sales to realize a target profit. Just the level of sales to realize a target profit. So how do we calculate this? This is simply equal to fixed costs plus target profit, and then we divide the whole of this by contribution margin. So the fixed costs, we are told that the fixed costs are increasing to 700,000 plus the target profit of 200,000. Then we divide the whole of this by CM, and the CM is changing. So we are told that the selling price is remaining constant, but variable costs are rising to 65. So what will be the sales? So this will be 25,714 units. And that's all about question number 3. So to give a summary of question number 3, you are to read more on marginal and absorption costing and application of break-even point in decision making. And so when we are calculating the break-even point, be able to know how to calculate the break-even point in different situations. When there is tax, when there is no tax, when there is a target profit, when there is no target profit, and the mathematical formula that are applied in all those situations. So that brings us to the end of our question number 3, and let's meet in the next session.
Yes, good day, my student. Welcome back to Manifested Online Classes. My name is Joseph Kimani. And in this session, or basically in this class, I want us to look on an illustration question regarding the topic of public financial statement. Remember, in our previous classes, we have already looked on how we prepare the statement of comprehensive income, statement of financial position, statement of changes in equity. And in this class, I want us to illustrate how we present the same using a past paper question. I want us to go through the question, and then from there we look on what was required. So the question reads, the following trial balance related to BD Limited as at 31st of December 2022. So we are given a trial balance for BD Limited at the end of the year. First of all, we have the property at cost, and you're told property include a building. Generally, if you're given property include land and building. So in our case, you're told the value of building is 400 million. So mean that the difference between 600 and 400 is the value of land. We have plant at cost, motor vehicles at cost, office equipment at cost, accumulated depreciation as at 1st January 2022 for buildings, plant, motor vehicles, office equipment. And then we have the inventory at the start of the year, purchases at cost, distribution cost, administrative expenses, revenue, trade receivables, and trade payables. We have the bank balance. We have the deferred tax, current tax, bank interest. And then from there we have the ordinary share capital, the share premium, the retained profit as at 1st January 2022, interim dividends paid, and then we have suspense. Then from there we have some additional information, note number 1 up to note number 6. And then what are we required? We are required to prepare the statement of, we are required to prepare the following financial statements in a suitable format for publication. In other terms, we are required to prepare 3 components here of financial statements in a format suitable for publication. 1, we are required to prepare the statement of profit or loss for the year which ended 31st of December 2022. B, a statement of changes in equity for the year which ended 31st of December 2022. And C, a statement of financial what? Position as at 31st of December 2022. Now, before we prepare what was being required here, definitely we need to go through the additional information. We see what we are told, and equally we see whether there is any working which is required. So in additional information number 1, you are told, during the year which ended 31st of December 2022, BD Limited disposed of an item of plant for cash proceeds of shillings 20 million, which were credited in the revenue account, and we are told no other accounting entries were made. The plant had a cost of 39.7 million and had an accumulated depreciation of 15.86 million. And then in the other point, you are told any gain or loss on disposal should be included within the cost of sale. So what you are told here is that this company disposed, or in other terms, sold an item of plant at an amount of 20 million. So this 20 million, which was received from the sale of the plant, we are told it was included as part of the revenue. First of all, that is wrong, because whenever the company sells an asset, that is a capital income. It should not be included in the revenue of the company. So therefore, when preparing the statement of profit or loss, what we are going to do, from the figure for revenue, we are going to less that 20 million. 2, anytime the company disposes or sells an asset, you have to prepare an account called disposal account for you to determine whether that item was disposed at a gain or at what? At a loss. And actually we are told that profit, all the loss on disposal should be part of what? Part of the cost of sale. So therefore, let's start with that working. Remember this illustration. This is illustration on the topic of published. So we start with the workings. We start with workings, and working 1 will be the preparation of the disposal account. I've said this is an account which is prepared anytime the company do what? Sells or disposes an asset, and we prepare this account to determine whether the asset was disposed at a gain or at what? At a loss. So how do we prepare this account? We prepare this account by debiting it with a cost, crediting it with 2 items, the accumulated depreciation and also the sales proceed. Then from there we balance our account. Any balancing figure on this side is a loss on disposal. Any balancing figure on this side is a gain on what? Disposal. So we are given those items. One, we are told we are given the cash proceeds. The cash proceeds is the amount which was received by the company after selling that asset. And if you check on the figures given in the trial balance, our figures are given in thousands of shillings. So therefore, for us to be consistent, we have to work with all our figures in thousands of shillings. So 20 million is the sales proceeds. And then we are also told that this plant had a cost. The cost was 39,700. That is a cost. And then we also given the accumulated depreciation as 15. Okay, that is the accumulated depreciation we recorded up there. 15 what? 15,860. So what we need to do, we balance our account here, and the balancing figure, if on the debit side is a gain, if on the credit side is what? If on the credit side is a loss. Is a loss. So let's add what we have on the credit, 15,860 plus 20,000. So that will give us 35,860. So mean that this side is more, and therefore our balancing figure will be on which side? It will be on the credit side. And how much will be our loss? It will be, we take that minus what we have on the debit, 39,700, and that will give us 38 what? 40. So this particular 3840, this is what? This is the loss on what? The loss on disposal. And what you're told is that this particular loss on disposal should be included as part of the cost of sales. And basically that's what we said in our previous class, that any gain or loss on disposal should be part of the cost of what? Sales. So that will be added in the cost of sales. And equally, we have said as far as that point is concerned, there are a number of adjustments we are going to make. The 20 million, this is the amount received from the selling that particular plant. We are told it was included as part of revenue. That is wrong. We are going to less that from the revenue. And then we also told that this particular plant which was disposed or which was sold had not been accounted for. What the company had accounted for is purely the amount received. And therefore, this plant which was disposed, we are going to less it from the plant of this company. The moment the company sells an asset, disposes an asset, such an asset should be derecognized. It should be removed from the company's books of accounts. That was not done. So therefore, we are going to make that adjustment, but you're going to make that adjustment specifically when preparing what is required in Part C. So let's move to the last point of note number 1. And you're told it is a policy. It is the company's policy to provide a full year depreciation in the year of asset purchase and none in the year of disposal. It basically means that whenever the company has acquired an asset in a certain year, even if the asset is acquired some few months at the end of the year, the company provide a full year depreciation, but none, no depreciation which is provided in the year of disposal. Basically, that information is to help you in terms of computing the depreciation for plant in note 2, because there was this plant which was disposed during the current year. So this plant which was disposed during the current year no depreciation will be provided as far as that plant is what concerned. But you're going to use that information in note 2. So let's go to note number 2, and you're told depreciation on property, plant and equipment is to be provided and allocated as follows. So let's compute those particular depreciations. As per note number 2, we compute the depreciation of items of PPE. We start by computing depreciation of the first item, which is what? Which is buildings. Buildings. So we are told buildings are depreciated at the rate of 2.5%. Using which method? Using straight line. So at a straight line, you have to recall we compute depreciation based on the cost. So what is the cost of buildings in the trial balance? The cost of buildings is 400 million. So we get 2% of 2.5% of that, 2.5% of that. And then also in note number 2, we compute the depreciation on plant, which is at the rate of 10%. Using which method? The reducing balance method. So under the reducing balance method, we compute depreciation based on what? Based on the net book value. Based on the net book what? Value. So what will be the net book value of a plant and the plant? So we take the cost, which is 280, and then we less the accumulated depreciation, which is 111, 116, 16. But now equally here, you have to remember there was this plant which was disposed. So therefore, because no depreciation which is provided in the year of disposal, we automatically need to eliminate that particular plant here. And basically we eliminate it here at its net book value. So what will be the net book value of that plant? So the net book value of this plant which was disposed will be, its net book value will be equal to its cost, which we have here, that is 39,700 minus the accumulated depreciation, which is 15,860. So that will give us now the net book value of this particular plant which was disposed, which was sold during the current year. We have 39,700 minus 15,860. So that will give us a net book value of 23,840. So because it's part of this and we are told no depreciation in the year of disposal, we need to deduct it there, 23,840. And basically you can see we are deducting it there at what? At net book value. So we are going to come back and compute these particular depreciations. Then let's go back to note number 2, depreciation on motor vehicles, which is at the rate of 20%. Using which method? Straight lines. At a straight line, we compute depreciation based on cost. The cost of motor vehicles is 70 million. 70 million. So we will compute that. We go back to note number 2. We compute depreciation on office equipment. Office equipment, which is 12.5%. Using straight line. Straight line, we compute depreciation based on what? Based on the cost. Based on the cost. Yes. So what now we need to do? We compute these particular depreciations. And remember in our case here, what you have said is that depreciations on items of PPE, this one is included as part of the cost of sales unless told otherwise. If you go back to that particular point, you'll be able to see how those particular depreciations are supposed to be classified. For example, depreciation on building is administrative and so on. But you have said if the question is silent, you always account for this depreciation as part of the cost of sales. So let's compute this. We start with the depreciation on buildings, which will be 2.5%. 2.5% times 400,000. 400,000. So that will give us what? That will give us 10,000. Will give us a figure of what? 10,000. 10,000. And then you are told that this particular depreciation on buildings, as per note number 2, this one will be part of administrative expenses. Will be part of the administrative what? Expenses. That is important. Then let's compute the depreciation on plant First of all, we compute this, and this was a figure of 280,000. This is a 280,000. 280,000. I hope that is correct. 280,000. Yes, we take 280,000. 280,000 minus 111, 160. 111, 160. I hope that also figure is correct. 111, 160. So, and then to this we less now the net book value of the plant which was disposed, 23,840. Okay, and then we get 10% of that, which will give us 14,500. How is this depreciation to be accounted for? As per note number 2, this will be part of the cost of sales. This will be part of the cost of sales. Then let's compute the depreciation on motor vehicles, which is 20% of the cost, which is 70, and that will give us 14,000. As per note number 2, this depreciation on motor vehicle should be classified as part of distribution cost. Part of distribution cost. Then we compute depreciation on equipment, which is 12.5% of the cost. And this will give us what? 5,000. And equally, as per note number 2, this is a part of admin. This is part of the administrative what? Expenses. So those are the depreciations. So, and I think we are done with that particular point. Let's move to point number 3. In point number 3, what are we told? We are told that it has been discovered that the former financial controller of BD Limited engaged or basically was engaged in fraudulent financial reporting of shillings 12 million of trade receivables that were non-existent and need to be written off. So basically what that means that the former financial controller of this company included in the receivables an amount of 12 million which are non-existent receivables, and therefore they need to be written off. So we are told that out of this amount, 7 million relate to the year which ended 31st of December 2022, which is now the current year. And therefore, that particular amount of 7 million, which relate to the current year, we are going to write it off and basically include it as an expense for the current financial year. So remember, these bad debts which are written off, this is written off as a result of a decision which has been made by the board or basically by the management. And therefore, such an expense which arises as a result of a decision which is made by the management of the company, by the board of directors, then we classify that as part of administrative what? Expenses. And then you're told with the balance relating to the prior what? Year. So therefore, those particular bad debts which are to be written off, which are for non-existence receivables, bad debts written off. So in that case, we are told that is an amount of 12 million. Is an amount of 12 million, but we said we are working with all our figures in thousands of shillings. So we are told 7,000 relate to the current year. So therefore, in preparing our income statement, this one we are going to include it as part of admin. And then now the difference, which is 5 million, this one is a prior year adjustment. Basically what that means, this amount of 5 million, it relates to the previous year. We don't include it in the income statement for the current year. It's not an expense for the current year. So what we do, we adjust it in the opening the opening retained profit or the retained earnings, because it was an amount which was supposed to be written off in the previous years, but it was not written off. So what we are only including in the income statement for the current year is 7 million. So let's go to note number 4. And in note number 4, we are told the existing debit balance on the current account in the trial balance represent the adder or over provision for previous year's tax. So if you go back to the trial balance, there is an item which you are given there, which is an item of current tax. So that item is below the bank balance, is below the deferred tax, and that item is an amount of 2600, 2600, the item of current tax, and you can see this is a debit balance. It is on the debit side of the trial balance. So this particular amount here, this one is what is under provision, is under provision of what, of current tax, because under provision of current tax from the previous years has a debit balance, in the trial balance. But if it was over provision will be having a credit balance. That is something which the examiner will not tell you, but any other provision of current tax from the previous year, this one will always be having a debit balance in the trial balance, and any over provision of current tax in the from the previous year, this will be having a credit what, balance. This is something you'll come across in most of the questions for published, but the examiner will not have specified whether it is over or other. Is upon you to know that other provision has a credit, has a debit balance, other provision has what, has a over provision has a credit balance. So therefore that is over, that item which we have is other provision. So how do we treat other provision of current tax from the previous year? So such other provision, we bring it forward to the current year and we add it. We do what? We add it to the current year's estimated tax liability. We add it to the current year's estimated tax what? Liability. But if it was an over provision, we bring it forward to the current financial year and we less it from the current year's estimated tax what? Liability. That's basically what you need to know, and therefore that's what you're going to do as far as that other provision is concerned. And then you're told, number 4, the second sentence, we are told the provision for current tax for the current year, that is the year which ended 31st of December 2022, was 42 million, or was 52 million is required, together with a decrease to the deferred tax provision of 3 million. So therefore, we are told the estimated tax liability for the current year is 52 million. So mean that we need to determine the amount of current tax to be charged in the income statement. So the amount of current tax to be charged in the income statement, what we do is that we take the current year's tax estimate, which is 52 million. But remember, in the previous year, we had other provision. The other provision which we have in the trial balance of how much? Of 26. And you have said that that other provision from the previous year, we added to the current year's tax what? Estimate. And this will give us now a total of 54,600. So this is the amount of current tax to be charged in the income what? Statement. In the same point, we are told there was a decrease in deferred tax provision. A decrease in deferred tax provision in the income statement, that one is accounted for as a deferred tax income. As a deferred tax what? Income. So because it's a decrease. Just the same way how we account for a decrease in provision for doubtful debt. A decrease in provision for doubtful debt, we account for it as an income. But an increase in any provision is accounted for as an expense. So therefore, that amount of 3 million, that is a deferred, tax income. A deferred tax income of how much? Of 3 million. Remember now these two items will be adjusted in the profit before tax. That's what we said in our previous or in the introduction class, that to the profit before tax we adjust two items, the current tax and also the deferred tax income, or what? Or expense. So we have that. Then let's move to the other note, note number 5. And note 5, we are given the inventory at the end of the year. This is now the closing inventory, no working which is required. And then number 6, you are told on 30th of December 2022, the company directors invited the current shareholders to subscribe for a right issue on the basis of 1 share for every 5 shares which were held at an exercise price of 15. And then you're told the come right price on the last day of trading was 20 shillings per share. So, and then you're told the proceeds from the fully subscribed right issue were credited in the suspense account. So I think what we need to do there is to determine how many shares were issued by the company during the right issue. How many shares were issued by the company during the right issue. So we are told this right issue which was made by the company to the existing shareholders, it was on the basis of one share for every 5 shares held. For every 5 shares which were held. So what we need to do first of all is to determine the shares held by this company, not held by this company, but the shares held by the members, the shareholders of this company. How do we determine that? We take the ordinary share capital of the company, which is given in the trial balance, which is 200,000. And to determine now the shares issued by the company, we divide that with the par value. The par value is the value per share given in the trial balance, which is 10. And this will give us 20,000 shares. So these are the shares which were held by the shareholders of the company. So the company was to, during the right issue, was to issue 1 share for every 5 shares which were held. The shares which were held were 20,000. So we need to determine how many shares were issued during the right issue. We take 1 times 20,000, we cross multiply, then we divide. Divided that with what? With 5. So this will give us what? 4,000 what? Shares. And we are told that these shares were issued at an exercise price of 15. So therefore what we need to do, we multiply the 2, and basically this will give us the amount which was received by what? By the company. The amount received by the company from the right issue, which automatically this one will give us what? 60,000. Now what you are told is that this particular amount in the last sentence of note number 6, the proceeds, the amount received by the company was credited in the suspense. Was that correct? No. Because what we know is that once the company make a right issue, the amount which was received should be debited in the bank account, That entry was made, but now the company credited suspense account. Is this what the company was supposed to do? No. So because these are shares which were issued, this account is not the one which was supposed to be credited, but the company was supposed to credit which account? The company was supposed to want to credit the ordinary share capital account. The amount credited in this account is always based on the par value per share. You take the shares issued by the company, 4,000, times the par value. The par value is the amount is the value per share we have in the trial balance, which we know is 10. So the amount to be credited in this account will be what? 40,000. So this amount of 40,000, we are going to add it to the ordinary share capital of the company. And then the amount which is above 10 shillings. You remember the shares were issued at 15. The amount which is above 10 shillings is a premium. So therefore, that would be credited in which account? The share premium. The shares issued, 4,000 times what? 5. Times 5. Times 5. So the total, which is 20,000, that is a share what? A premium. So therefore, the adjustment which will be made as far as that note is concerned is that when preparing the statement of changes in equity, to the ordinary share capital, we are going to add 40,000. To the share premium, we are going to add what? 20,000 in relation to these particular shares which were issued by the company during the current year. And I think we are through now with the notes. What we need to do, basically we can proceed and prepare what is required. So let's start with the part A of that particular question. And what is required is the statement of profit or loss. So first of all, we need to have the name of the company. The name of the company is BD Limited. And this is a statement of a profit or loss. Statement of profit or loss for the year which ended 31st of December 2022. 31st of December 2022. So that is basically our title there. Our title. And then now we have to use the format which I gave you. Remember, I gave you the format for this. That is the exact format we use here. So, and remember, all our figures are in thousands of shillings. And here we only have one what? One column. So what do we start with here? We always start with the revenue. The revenue. And the revenue is something which are given in the trial balance. The revenue for this company in the trial balance is given as a figure of what? As a figure of 1123 500. But remember, there is an adjustment which you are going to make here as far as note number 1 is concerned. So this plant which was disposed by the company, we are told this amount which was received, the sales proceeds, this was included as part of the revenue. Yes, so to this figure, we need to less 20,000, which was included here as the amount which was received from selling the asset. That amount should not be recognized as a revenue because this is basically a capital income, a capital revenue. So any amount realized from the selling an asset should not be included here. So I think that now will give us a figure of what? A figure of 1103 500. So, but we can confirm that. Let's confirm whether that is correct. So we have 1123 500 minus 20,000. Minus 20,000, that will give us 11,035 what? 500. And then to this, what do we need to do? We need to less the cost of sales. We need to less the cost of what? The cost of sales. Cost of sales. Now, are we given the cost of sales? No, we have to compute it. Remember, I gave you the formula for computing this. We take the opening inventory plus purchases minus closing inventory plus any depreciation plus any loss on disposal minus any gain on disposal. So what we include here, one is the opening inventory, which is given in the trial balance, 138,000. To this we add purchases, which is just below the opening inventory, which is 667,000. To this we less the closing inventory. Where do we have the closing inventory? Note addition information number 5, which is an amount of 85,000. And then to this we add any loss on disposal. Remember, here we have a loss on disposal, which is 3840, and any depreciation on PP. We have various depreciations here, and part of them should be included as part of the cost of sales, starting with the depreciation on plant, which is 14.5. Do we have any other depreciation which should be included as part of the cost of sales? No. So that's how we are going to arrive at the figure for the cost of sales. Opening inventory, purchases, closing inventory, loss on disposal, and then the what? And then this depreciation on what? On plant. So let's get the final figure here. We get the final figure. So we have what? We have 138,000. 138,000 plus 667,000 minus 85,000 plus 3840 minus 14,500 minus 14,500, and that will give us a figure of what? It will give us a figure of 709,340. 709,340. 709,340. So we less that from our revenue up there, and whatever you get here is the gross profit. The gross profit. So how much would be our gross profit? We deduct that from 1103 500, and this will give us a 598,990. That is our gross profit. So to this gross profit, next we said we add other income. So when checking for other incomes, what basically you do, you go back to the trial balance and you check other incomes on the credit side. All incomes, they have a credit balance. So you go through the items on the credit side of the trial balance. We see whether we have any other income. Up there you can see we have accumulated depreciations. Those are not incomes. Down here we have revenue, payables, bank balance, and then deferred tax. And then we have ordinary share capital, share premium, retained profit, and down there we have what? Suspense. So basically in our case here, we don't have any other income. We don't have any other what? Any other incomes. We don't have any other what? Income. So then to this we go straight to deducting our expenses. Our expenses, we we can start with just what we have in our trial balance. Below the opening inventory and purchases, we have the distribution cost. Distribution cost. So the distribution cost in our trial balance is given as an amount of 44,000. So there are some depreciation which are part of the distribution, and that is the depreciation on what? On motor vehicles. So that one we included here, and that is an amount of depreciation on motor vehicles is an amount of 14,000. So this will give us a total of 58,000. So below the distribution, we have the admin expenses, administrative expenses. So equally that need to be adjusted. We can do our adjustment with here. So we have 93,500. So and then we need to include the depreciation on what? On buildings, which is 10,000. And then also this depreciation on what? On office equipment, which is 5,000, which is 5,000. There is something you should also, we also need to remember to include here. There was this bad debt which was to be written off and which related to the current financial year, the amount of how much? 7,000. We said it should also be part of administrative expenses. Yes. So and I think now we can get the total administrative expenses. We have 93,500 plus 10,000 plus 5,000, or we can just take 5,000 plus 7, which will give us a total of 12. Yes, and that will give us total administrative expenses of 115,500. And then below the administrative expenses, I think we have revenue. Okay, we have trade receivables, bank balance, deferred, current, and then we have the bank interest. Now this bank interest will be included here, but we include it here as part of the finance cost. And I think this is the only item which will form part of the finance cost, and that is an amount of how much? That is an amount of 24. And then now what we need to do is we check whether we have any other expense, or this company had any other expense which has not been classified as part of cost of sales, distribution, admin, or what? Finance. So we just go through the trial balance and we check the items which we have on the debit column, because all expenses, they have a debit balance. So first of all, up there we have assets. Those are not expenses. Down there I can see inventory, purchases. Those are not expenses. We have already captured distribution, admin. Down there we have receivables, that is an asset. Down there we have current tax. Remember that was at a provision. That is not an expense. Bank interest, we have already captured that there in our income statement as what? As finance costs. And then down there we have interim dividend. So basically that is not what? An expense. And I think then what we have in the additional information, number one, we had the loss on disposal. We have already captured that as part of cost of sales. Note 2, we have these 4 depreciations. Depreciation on buildings, that was supposed to be included as part of what? Admin. We can confirm whether this has been included as part of the admin. 10,000 is there. Then depreciation on plant is part of the cost of sales. Have we included that here? Yes. Motor vehicles, its depreciation is part of distribution. 14,000. Have we included as part of the distribution? Yes. Office equipment, its depreciation is part of admin. 5,000. Has it been included as part of that? Yes. Okay. And then number 3, we have this amount to be written of 7, which should be part of admin. Have we included that there? Yes. And then number 4 is about tax. current and deferred, that will be deducted from our profit before tax. And then number 6 is all about, number 5 is about closing inventory. We capture that there. Number 6 is about late issue that do not affect our what? Expenses. So basically what that means is that we don't have any other expense. We don't have any other expense. So what we need to do here is we get the profit before tax. The profit before tax. Our profit before tax will be, we take now the total incomes minus the expenses there. So we have 598,990 minus 58,000 minus 115,500 minus 2,400, and that will give us a figure of what? A figure of 423,090. So that is the profit before tax. And then to this we need to less what? We need to less the income tax expense. Income tax what? Expense. And for the income tax expense, this comprises of two components of tax. The current tax, and the current tax, we computed that figure there, which is 54,600, and then we also have the component of deferred tax. What did we have here? We had the deferred tax income. Deferred tax income, and because this is an income, a deferred tax income, we don't less it from our profit, but rather what we do, we add it. That's why we refer to it as a deferred tax what? A deferred tax income. So we take our figure here, which is 423,090 minus 54,600 plus 3,000. And that will give us 371 for what? 490. So what is this? This is the profit for the year. The profit for the year. So to this profit for the year, we said then we proceed and we add other comprehensive incomes. Other comprehensive what? Incomes. Other comprehensive incomes, we said these include revaluation gain or loss on PPE, revaluation gain or loss on a financial asset at fair value through other comprehensive income. But if you check on what we have in this particular question here, we don't have any other comprehensive what? Income. So basically what that means is that our total comprehensive incomes will be the same with the profit for the year, 371 for what? 490. So basically that is it. That's what was required as far as Roman 1 of that question is what? Is concerned, or part A of that question is concerned. Hi candidates, welcome to another session of Manifested Online Classes. So in this session, I want us to continue with the subtopic of impairment of non-cash generating assets. And in this particular session specifically, I want us to look on some illustration questions regarding how to determine the impairment loss of non-cash generating asset under the three approaches we have discussed in our previous session. That is depreciated replacement cost approach, restoration cost approach, and what we refer as the service unit approach. So let's read or go through the particular illustration. We see what we are told, and it reads, on 1st January 2009, the government built a market at a cost of 150 million. The market was expected to provide services for 40 years. On 31st of December 2018, after 10 years of use, a fire caused a severe structural damage to the market. Due to safety concern, the market was closed down for repair that would cost 106.5 million. These repairs were made to restore the market to occupiable condition. The current cost of a new market is shillings 300 million. So what are we required is to determine the impairment loss to be recognized for the market using the cost restoration approach. So what we are required to do there is we determine the impairment loss using a restoration cost approach. So the first thing which you need to remember here as a student is how do we determine the impairment loss of an non-cash generating asset under IPSAS 21. So the impairment loss is equal to the carrying amount of a non-cash generating asset, which is the same with the net book value, minus the recoverable service amount. The recoverable service amount. So therefore, what we need to do for us to be able to determine this particular impairment loss, we have to determine these two values, the carrying amount and also the recoverable service amount. So let's determine we start by determining the carrying amount. Carrying amount, which is the same with the net book value. And we are determining this on which date? On 31st of December 2018, because what we said in our previous session is that impairment review is undertaken whenever there is a factor or indicator showing that the asset could be impaired. And actually what we are told is that on 31st of December 2018, this market, which was constructed by the government, which is a non-cash generating asset, was damaged by fire. So that is a factor which indicate that this market, which is a non-cash generating asset, could be impaired, and therefore the impairment review must be carried out on that date. So we need to have the two values on that date. So the net book value or the carrying amount, this one is equal to the cost, and we are given the cost of the market, which is 150 million. So we less the accumulated depreciation. So the accumulated depreciation in this case will be computed by taking 150 million. And then in sentence number 2, we are told that this particular market, which was constructed by the government, it was expected to provide services for the next 40 years. So anytime you're given the expected useful life of an asset, you then determine its depreciation using the straight line method. You take the cost divided by the estimated or the expected useful life of that particular asset, and then this will give us now the depreciation per annum. So what we need to do is to determine, we are determining depreciation for how many years. So from 2009, when the market was constructed or was built, up to 31st of December 2018. So how many years do we have there? So we have 2009, 2010, 2011, 2012, 2013, 2014, 2015, 2016, 2017, 2018. So these are how many years? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So we have 10 years. So meaning that our interest is to compute or to determine the accumulated depreciation for how many years? For 10 years. So this is the cost, which is 150 million. So let's compute this particular accumulated depreciation, which will be equal to 150 divided by 40 years times 10, which will give us 37.5 million. 0.5 million. We less that from the cost, and whatever you get here is the carrying amount or the net book value. So we less that from 150 million, which will give us 112.5 million. So having that, then we proceed and we determine the recoverable service amount. So we have to recall what we said in our previous session, that the recoverable service amount, this is the higher of two values, over two values. Number one, the fair value less cost to sell, which is also known as the net realizable value, net realizable or we can just abbreviate it as, we can just put it as NRV, net realizable value, or Roman 2, what we refer is the value in what? In use, the value in use. Now, if you check on the information which are given in this particular question here, you'll be able to see that the examiner has not given us what we refer as the fair value less cost to sell, because the fair value less cost to sell, this is the amount at which now the asset can be sold at currently minus any cost which will be incurred in selling that particular what asset. And as per the information which you are given, this figure is not provided. So this figure is not provided. So therefore, this will not apply in our case. We are not going to consider that figure there. What we need to do is we proceed and we determine the value in use. Now, remember in our previous session, we said we have three methods, three approaches which can be used to determine the value in use. But in this particular question, the examiner is requiring us to do that using a method which is known as what? The restoration cost approach. So therefore, we are determining the value in use using the restoration cost approach, restoration cost approach. So how do we determine the value in use under the restoration cost approach? So first of all, we take the replacement cost, which is basically the cost which will be incurred currently in terms of replacing that asset which is damaged. And I think in the last sentence of this particular question, we are told the current cost of a new market is 300 million. So if the government want to construct a similar market currently, that will cost the government 300 million, meaning that this is the replacement cost. Then what we do, we depreciate this replacement cost for this equivalent duration. So what that means is that to this replacement cost, we less accumulated depreciation, which will be equal to the replacement cost. And then we are saying we depreciate 300 million for an equivalent duration. So meaning we divide that with 40, just like what you have done here, times what? Times 10. Times 10. So this will give us now an amount of how much? So we have 300 million divided by 40 times 10. So which will give us 75 million. We less it from that figure, which will give us 225 million. So whatever you have here, we refer to this as depreciated replacement cost. Now, after getting that under this particular approach here, we proceed and we less the restoration cost. So remember, we said the restoration cost in our previous session is the cost which will be incurred in terms of restoring an asset to its pre-impaired state. So essentially, we said that this is equivalent to the repair cost. How much repair costs will be incurred by this particular public sector entity in terms of repairing an asset which is now deemed to be impaired? And I think if we go back to the question which you are given, to the information which you are given, we are told due to the safety concern, this market was closed down for a repair to be done, and we are told that repair will cost, or basically the repair cost is 106.5 million. So that is now the restoration cost. So we less it from our figure up there. So you have 225 minus 106.5. So which will give us 118.5 million. 0.5 million. Yes. So this is now what? This is the value in use. The value in use. So having the value in use, next what we need to do is to determine now the recoverable service amount. The recoverable service amount, of which you are saying the recoverable service amount should be the higher of these two values. Should be the higher of what? Of the fair value less cost to sell, this one, and the value in use. And take into account we don't have this value, it is obvious that our recoverable service amount will be equal to the value in use. So therefore, the recoverable service amount is 118.5 million. 0.5 million. So having that value, what we need to do is to determine whether this asset is impaired or not. Remember, we said that an asset is said to be impaired whereby the recoverable service amount of such an asset is less than the carrying amount. So in our case, we already have these two values. So we have the recoverable service amount, which is a figure of 118.5 million. What about the carrying amount? The carrying amount is what we have here. That is 112.5 million. So we need to check, is this particular amount here, recoverable service amount, is it less than this? So obvious, this one is not less. This one is not less than the carrying amount, is not less than the carrying amount. What does that mean? It means that this particular market here, this particular non-cash generating asset here is not impaired. Is not what? Impaired. Therefore, no impairment loss which is to be recognized. So that will be the answer here. So we say the asset is not impaired, simply because the recoverable service amount is not less than what? The carrying amount. The asset is not impaired, and therefore no impairment loss is to be recognized. No impairment loss is to be what? Is to be recognized. So basically that is it, that's what was required. So let's move to the other illustration, and it reads, on 1st of January 2014, the government acquired a modern software to enhance the service delivery at a cost of 350 billion. The software had estimated useful life for over 8 years, and its benefits would accrue evenly on a straight line basis over the software useful life. As at 31st of December 2018, the usage of the software had dropped to 15% of its originally anticipated demand. A software to replace the remaining service potential of the existing software would cost 150 million. So what are we required? We are required to determine the impairment loss to be recognized for the software using the depreciated replacement cost approach. So here what we are required, remember this was Roman 1 of our illustration. That was Roman 1. Roman 2, we are also required to determine the impairment loss to be recognized, but using which approach? Using the depreciated replacement cost approach. And it is also important for you to recall that the difference between these three methods, what we have done here, restoration cost approach, the depreciated replacement cost approach, and the service unit approach, the difference is purely how we determine the value in use. So how we determine the carrying amount and the net realizable value, the approach is the same. The difference comes in when determining the value in what? In use. So what we just need to remember here is, or we need to have the formula for computing the impairment loss, which you have said is equal to carrying amount, which is the same with the net book value of the asset, minus the recoverable service amount. So we need to determine these two values, and basically we are determining this particular impairment loss on the date when there was some evidence showing that this particular asset could be impaired. And I think there is some information which you are told there, or which you are given, whereby you are told on 31st of December 2018, the usage of this software had dropped by 15%. Had dropped by 15 what? %. So meaning that the performance of this particular software is worse than what was originally expected. So this is one of the factors which indicate that this particular asset could be impaired, and therefore in accordance with IPSAS 21, the public sector entity should carry out impairment review at the end of 2018. So therefore we are determining this carrying amount, this particular net book value, on that date, on 31st of December 2018. So to compute this is basically quite simple. We take the costs of the software, which we are given in the first paragraph, which is 350 million, and then we less the accumulated depreciation. How do we compute the accumulated depreciation? We take 350 million, Divide that with the expected useful life of this asset, which are 8 years. And then on this date, this particular software had been used for how many years? So remember, it was acquired at the start of 2014. So meaning that it was used, the software was used in 2014, 2015, 2016, 2017, 2018. Those are how many years? 1, 2, 3, 4, 5. So we need to compute the accumulated depreciation for 5 years. And basically that will give us what? That will give us the net book value or the carrying amount. So let's compute that. We work out that. We have 350 divided by 8 times 5. We rest that from the cost of 350, and that will give us 131.25 million. So that is the carrying amount or the net book value at the end of 2018. So then from there we proceed, and we already have this, we proceed, we determine the recoverable service amount. Recoverable service amount. That is the abbreviation for that, recoverable service amount. And basically this is the higher of two values. This is the higher of two values. Number one, the net realizable value or fair value less cost to sell. And equally, if you check on the information given in this particular question here, this figure is not given. We are not given the NRV, the net realizable value or the fair value less cost to sell. So that will not apply here. So we take the higher of that, or number two, what refers the value in use. The value in what? In use. Now the value in use, which approach are we using here? The examiner requires to compute this using this particular approach, the depreciated replacement cost approach. So therefore, that is the approach which you're using here, depreciated replacement cost what? Approach. Yes, so let's determine the value in use under that particular approach or method. Value in use. So to determine the value in use, what we do, we take the replacement cost. The replacement cost is basically the cost which will be incurred by the government in constructing a similar market. We are given that information, not a similar market, but in terms of acquiring a similar software. A similar software, we are told acquiring a similar software currently, or a similar software currently goes for 150 million, and we depreciate this, or to this we less accumulated depreciation, which will be equal to the replacement cost, which is 150, and we depreciate this for an equivalent duration as this particular asset. Divide that with 8 times what? Times 5. Times 5. So let's work out that. We see what it will give us. We see what we are going to get here. We have 150 divided by 8 times what? Times 5. Times 5, which will give us 93.75 million. And whatever you get here is now the value in what? In use. So that is how we determine the value in use under this particular approach here, or under this method, which is depreciated replacement costs approach, which is 56.25. So having that, finally, we need to get now the recoverable service amount. Recoverable service amount. The recoverable service amount, you should take now the higher of this value in the value in use and the fair value less cost to sell. In our case, remember, we don't have that, so automatically our value in use will be equal. Sorry, our recoverable service amount will be equal to the value in use, 56.25 million. 0.25 what? Million. So having that, then we equally need to determine whether our asset is impaired or not by checking whether the recoverable service amount, whether this amount is less than the carrying amount. Is less than the carrying amount. This was supposed to be less. It's supposed to be less than the carrying amount. So the recoverable service amount is 56.25 M. What about the carrying amount? Is this one, 131.25 million. So in our case, we can say this one, the recoverable service amount is what? Is less than this one. So meaning that we need to proceed and we determine what? The impairment loss. So the impairment loss is determined using this formula. So the impairment loss is equal to carrying amount, which you already have here, 131.25 million minus the recoverable service amount, which we have here, 56.25 million. And we get the difference. We get the difference. Yes, so which will be 75 million, 75 million. So that is basically the impairment loss, or how we determine the impairment loss using that particular what? Using that particular approach, which is known as the depreciated replacement what? Cost. I want us to look on the last illustration. We look on the last illustration. So let's go through the illustration. We see what we are told. So the illustration leads with reference to IPSAS 26, which deals with the impairment of cash generating asset, explaining the following terms. So IPSAS 26 basically is equivalent to IS 36. So the definition of those particular terms under IS 36 is the same with the IPSAS 26. So the first term we are required to define is the value in use. So the value in use, in very simple terms, is the present value of the expected cash flows to be generated from the continued use of the asset and also from its what? Disposal. So what about the recoverable amount? The recoverable amount, this one, is the higher. We say this is the higher of cash generating assets, value in use, or number two, fair value less cost to sell. Less cost to sell. That is how we define those particular terms. And then part B, that is what I want us we compute here, or basically we do. So we are told on 1st January 2008, Mashabani County Education Department purchased a printing machine at a cost of 40 million. The department estimated that the useful life of the machine would be 10 years. And then you are told on 31st of December 2012, it was reported that automated feature of the machine function did not operate as expected, resulting in 25% reduction in the machine annual output over the remaining 5 years of its useful life. The cost of a new printing machine was 45 million as at 31st of December 2012. So what are we required to do? We are required to determine the impairment loss using the service unit approach. So we are required to determine the impairment loss using service unit approach. Using a service unit what? Approach. The first thing always you need to have here is the formula for computing the impairment loss. The impairment loss is equal to a carrying amount of the asset minus the recoverable service amount. Recoverable service amount. So we need to have these two values. Let's start by determining this one, carrying amount. Carrying amount, which is basically the same with the net book what? Value. And equally we are determining this when there was a factor which showed that this asset could be impaired. And there is some information which are given in that question that on 31st of December 2012, it was reported that automated feature of this machine was not operating as expected, resulting in 25% reduction in the machine annual output. It means that the performance of this asset was worse than what was originally expected due to that feature, automated feature of the machine not working as what? As expected. Therefore, an impairment review was supposed to be conducted on 31st of December 2012. So how do we determine the carrying amount? We take the cost, which we are given in paragraph 1 as 40 million. 40 million, we less the accumulated depreciation. The accumulated depreciation would be 40 million. Divide this with the expected useful life of this machine, which are 10 what? 10 years, and then times the number of years the machine had been used before the end of, or basically as at 31st of December 2012. So how many years do we have? Take into account it was acquired in 2008. So we have 2008, 2009, and then we also have 2010, 2011, 2012. So these are 5 years. 1, 2, 3, 4, 5. So we have 5 years. 5 years. So this will give us what? This will give us 20, meaning that the carrying amount or the net book value will be what? Will be 20 million. So having that, we proceed and we determine now the recoverable service amount. The recoverable service amount, which we know by now that this is the higher of two values. Higher of number 1, net realizable value, or the fair value less cost to sell. And in our case, equally, we are not given this. We are not given this. In most of the questions, it is important to note that you not be given that fair value less cost to sell, because it is very rare for the government to be able to sell its asset. To be able to sell its what? Its asset. That's why you can see actually in all questions which you have done, there is nowhere you have been given, or there is no question or no illustration whereby you are given the fair value less cost to sell. So we take the higher of that all. Number 2, the value in use. The value in what? In use. Now, this value in use, we are required to compute that using this approach here. The service unit what? Approach. Service unit what? Approach. So how do we determine the value in using this particular approach? The first thing we need to do is to compute the depreciated replacement cost. So we take now the replacement cost, which is also given in that question in the last sentence, whereby you're given the cost of a new printing machine. If the government want to acquire a new printing machine currently, such a machine will be bought at 45 million. So what we need to do is we less accumulated depreciation, which is computed by taking the replacement cost, and then we depreciate that amount with an equivalent duration. So we divide this with 10 times what? Times 5, which is basically half of that, 22.5 million. And whatever you get here is known as the depreciated replacement cost, which equal to be 22.5 million. So having this depreciated replacement cost and the service unit approach, we say to get the value in use, we take the depreciated replacement cost, and then we multiply that with the proportion of the remaining service potential. We multiply that with the proportion of the remaining service potential. There is something which you are given in that particular question, whereby we are told, due to that automated feature of the machine not operating as expected, the annual output of this machine in the next 5 years was expected to reduce by 25%. So meaning that the remaining service potential of this particular machine over the next 5 years, we can say is 75%, because the annual output of this machine in the next 5 years is expected now to do what? To reduce by 25%. So therefore, what we have done to compute the value in use, we have taken the depreciated replacement cost, and then we have adjusted that. We have multiplied that with the proportion of the remaining service remaining service units. So we have 22.5 times 75%, which will give us now what? Which will give us 16.875 million. And I think now, having that, finally what we need to do is to determine the recoverable service amount. We determine the recoverable service amount, of which the recoverable service amount automatically will be the higher of these two values here. So remember, in our case, we don't have this. So automatically the recoverable service amount will be equal to value in use. The value in use is this one, which is 22.5 million. 0.5 what? A million. And I think having that, finally, we need to determine whether this asset is impaired or not by comparing the two values, by determining whether the recoverable service amount is less than carrying amount. So our carrying amount, we have it here, 20 million. What about the recoverable service amount? Is 22 point, not 22, sorry. This should be whatever I have determined here. Let's change that. So this, the recoverable service amount is 16.875 million. So our recoverable service amount is 16.875 million. So what we need to do is basically to determine, is this less than that? Yes. So we can see the recoverable service amount is less than the carrying what amount. If that is the case, then finally we need to determine the impairment loss, because this particular asset is impaired. If the recoverable service amount is less than the carrying amount. So the impairment loss will be equal to carrying amount, which is 20 million, minus the recoverable service amount, which is 16.875 million. So what will be the difference here? It is 3.125 million, and that is the impairment what? The impairment loss. So basically that is it, that what was required in those particular three illustrations, whereby the examiner was requiring as a candidate, you compute the impairment loss of non-cash generating asset in accordance with the IPSAS 2021. So therefore, we have looked on how to compute the impairment loss under the depreciated replacement cost approach, under the restoration cost approach, and also under the service unit approach. And basically that brings us now to the end of that subtopic. So once we meet in our next session, we are going to look on how we determine the impairment loss under IPSAS 26. So for now, we stop at that point. See you in the next session.
Hello learner, welcome to Manifested e-learning platform. My name is F.A. Mlingwiri, and today, ladies and gentlemen, we are discussing about the Business and Data Analytics August 2023 paper. The question of focus today is question 22. It reads as follows. Riziki Limited is considering a project with the following details. Initial cost 40 million, residual value 2.5 million, selling price per unit is 1.1, variable cost per unit 500, I meant 1,100, pardon me. Then variable cost per unit is 500, fixed cost per year is 5 million. Additional information, annual number of units sold is 30,000. The project has a useful life of 5 years. The company uses a weighted average cost of capital or WACC of 12%. Required, A, compute the base net present value. B, carry out a sensitivity analysis of NPV assuming adverse variance of 5% for all inputs except project life and weighted average cost of capital. C, prepare an appropriate chart to indicate the different NPVs for each scenario in B above. Note, adverse variances in this case means a decrease in cash inflows or an increase in cash outflows. So what we're going to do, ladies and gentlemen, we are going to, you can see towards the right of the screen over here that we've developed inputs: the initial cost, the residual value, the selling price, the variable cost per unit, and the fixed cost per year, and the project life there. So what we're going to do then, we're going to now identify the inputs, of the major inputs towards the right. Like for example, what I mean is this. We are going to now talk about the base. Here we're going to talk about the base case, input based on the input, so base. That. And then towards the right, we are going to include a 5% initial cost, or positive value of 5% initial cost. So we are going to have plus 5% initial cost, like that, and then we will now then have now the adverse scenario where we have negative 5% annual unit sales. So negative, I'm going to do like that, negative 5% annual unit sales. So with that, we proceed on to get or to also identify now the 5% selling price. So negative 5% selling price. Then we continue building on the model itself. Right here we have variable cost. Now increase in variable cost, 5% variable, 5%. I'll explain variable cost, and then we're just following these components right over here. So we began with the initial cost, then we went to the annual unit sales, then the selling price, then you're going to the variable cost over here of 5% variable cost, and then residual value there. So negative 5%, negative 5%, 5% residual fixed cost. I think I forgot fixed cost. So positive 5%. Apologies for that. Positive 5%. 5% fixed cost. And then we're talking about residual value right here. Residual value. %, residual value. That. So with that, we are saying that we are told to compute the NPV. So the inputs, then we just follow the inputs based on whatever we've been given. So the residual value right over here, we can come to the initial cost. You can see the initial cost is 40 million over here. So it's 40 million. We're just doing the base case scenario over here. So what I can do, I can put this perhaps on that side like that. So that now, and maybe perhaps I can, with your permission, I can just compress it a bit over here like that so that you can be able to fill out this part. So the initial cost right here, you can see is 40 million like that. So 40 million. And we come down there. So we want the comma format, guys. The comma format. So we highlight everything, put a comma, then just like that. So here the initial cost plus that value there. Then we have the residual value are going down. The residual value is given to us over there. That value there. Because we talk about the base case. And then the annual unit sales. The annual unit sales you can see is right here. Additional information number 1. So 30,000. So just put and plus 30,000. Because this is in words, it's not separated from the words. So it's in figures combined with the words. So just put 30,000 there. we have the selling price per unit given to us. The selling price per unit, you can see, is given to us on the right here. So enter that. The variable cost per unit as well, given to us there, enter. Then the fixed costs per year have also been given to us there. So plus, enter there. The project life in years, we have been told in note number 2 that the project has a useful life of 5 years. So we just indicate here 5. That. So what happens then when we have an increase on initial cost? So the increase in initial cost will be, we can put 5% over here because we're saying it's going to be 5% increase over here. So you put just 5%, and we increase. So this will all require this to have a percentage. So allow me to do this, to do the following, to put this as percentage over here, comma format here, that. So don't worry about this. These are just the marks that are being allocated towards the entire question. So you can see it's 30 marks over here. So with the permission, and I can just do away with that. Or rather, I can just put them beside the questions over there. However, we can just do away with them for now. So with 5% increase, we just come over here plus that value times a factor of 1 plus, we're increasing it by 5%. That's what it gives us, 42 million. With 42 million, we are saying the residual value remains as the way it is over here. Because we're saying that the residual value will remain as 2.5 million all through, whether there is going to be an adverse effect or so on and so forth like that. So here is 2.2 million like that. We proceed on, and even the number of units, this will be the same. The annual unit sales will be the same, 30,000. Here we are saying it's going to be 1100 like that. So I can just copy these values as the way they are towards the right there with your permission. Because we are saying that the initial cost is the one that is only increasing. So here you see copy, paste special values, and I say okay, that. So if that's the case, what happens when we have a decrease in unit sales, 5% decrease in unit sales? Because we're saying from the question right here that carry out a sensitivity analysis for the NPV assuming adverse variance of 5% for all the inputs except the project life and weighted average cost of capital there. So we are saying that now we want to put adverse effects over here. So we are going to have negative 5% like that. You can see it's even indicated to us over here. So here we are saying is going to come back now back to this, because we're saying we increased it from this to this based on the 5%, but now it's going to come down. And so I'll increase now each of these items moving towards the right there. The annual unit sales, the selling price, the variable cost, and so on and so forth. So that now right down over here we can now do the workings effectively. So you can say plus that value times 1 plus it should be because you're decreasing this value over here 1 no so this is the formula, it's plus that value. We're decreasing it by 5%, so it should be delete plus this value, and then we're multiplying it by, open the brackets, 1, decreasing it means, so it's going to be we're subtracting it from 0.05. So 1 minus 0.05. That it shouldn't give us 1 minus 0. We're talking about 5% adverse effect, because we're saying from here, if we increase this one by 5%, so then decreasing it should be able to give us it should be able to give us take us back to where we actually were before, were there. So it should be just 40 million. That. And with 40 million, then we are saying that we can move ahead and say that variable cost is going to now also selling price the variable cost is going to decrease over here. So we put negative 5% in terms of selling price, sorry. So negative 5%. So we put that, and it remains the same. Over here I'll explain that. If you're talking about the variable cost itself, also it also remains the same like that. So it's going to remain, including the residual value, like that. But what we're saying is that here we will need then to put 5%, because we're saying it's 5% variable cost, 5%, then negative 5%. Because it's positive there. So we are saying what? That in terms of the initial cost, if it's going to increase, it's going to increase by 5%. If the unit sales decrease by 5%, then it's from this increase, it's supposed to decrease to 40 million back again. Then what about the residual value? The residual value should remain the same, with the exception of the very final residual value down over here. So it should remain the same here. So we just maintain it like so, up to there. But you're saying that the very final one over here is going to, this residual value is going to be plus that value times, open the brackets, 1 plus should be that value there. The residual value represents an inflow of money when you sell the asset. So we are saying that at this point over here, the residual value, a 5% decrease in residual value will cause it to be over there. That. So that's what we have. We proceed on to discuss the next item, talk about the annual unit sales. The annual unit sales will affect what? Will affect this component right over here, this column over here, the annual unit sales. So here we are saying it's going to decrease, so plus that one times, open the brackets, 1 plus that 5%, negative 5%, 28,500. But the rest remain the way they are. These other values remain the way they are. So 30,000. So plus sorry, pardon me for that. And so it should remain 30,000. That should remain the same. Control R. It's only the unit sales. Why? Because you're saying that the unit sales are the ones which are being affected. The sales, we're dealing with unit sales. So this annual unit sales component should actually change. Next item is the selling price per unit. So what would change? So selling price per unit, this is what is going to change, that part there. is going to change, pardon me, that one is the one that's going to change. So here we are saying it remains at 1100. So here we are saying it's just going to be that, because it has already changed. This one remains the same, but the selling price changes based on that component there. So we are saying the selling price is going to be plus that one times, open the brackets, 1 plus selling price, comes to 1045, but the rest remain the way they are. How about the variable cost per unit? Variable cost per unit remains the same with the exception of the variable cost component. So here we expect it to remain the same. So we drag it up to there. But that value times, open the brackets, 1 plus the variable cost is increasing. 525, then the others remain the way they are. The fixed cost per year. The fixed cost per year, we are saying is going to be 5 million with the exception of the fixed cost component. Or just put it like so, up to there, Control R. So this one is just going to change plus that value times, open the brackets, 1 plus that value, and we enter. Then we remain with enter. We will have it like that. How about the project years? The project years remain the same. We've been told it's 5 years, so it goes without saying that it's going to remain 5 years. Just leave it like that. And with that, now those are the inputs that we've worked out. We now want to proceed to work out the solution. So the unit sales, we start by identifying the unit sales over here. Unit sales, over here we have, and of course here we have the base case given to us there. This one should be slightly above here because we do not fill in. So base case. That. Then here we are saying we are going to now put in the figures. The unit sales, 30,000. So we have them there. And then we copy these components towards the right here. Copy. Towards just the right here. Base, just the same way. Then we have the initial cost is going to be how much? We're just going to copy and pick it from there. So the initial cost in terms of the unit sales is just going to be the same. You can see that because you're talking about the initial cost here. So when you're talking about the initial cost, we're just going to copy it like that. So enter. So the initial cost, we just pick it over there, just from above over here, because the initial cost is going to be an increase. So then the annual unit sold. So we just then autofill Control R, with the exception of this one where we're saying the annual unit sales changes over here. Remember how we did it over here? Is what we're saying actually changes there. The next component is the selling price. Selling price. So we move like so. Selling price. Price. And the selling price or SP is given as plus that value. Enter it like that. Remember where it changes. It changes at the point where we have the selling price component there. So if it picks from above there, so just put it like so. You can see the selling price changes at that point here. Next component, next item is the total sales. Total sales. And you're saying the total sales is going to be given as we multiply you're just going to pick the values here given to us over here. Total sales plus, from the question, just to clarify over here, one second, I get it. It's just going to be this value of here, selling price, times that value. That's what we're getting. Sorry. And once we have that, we proceed on to identify the next component there. And with that, we're saying we'll just be able to just pick the values, dragging them over here. Sorry, I was just having a bit of a small hitch. Sorry for that. So Control R. And you can see what happens there. We just pick the selling price and then we multiply with the unit sales. So what happens then now with the next component? So those are total sales. Once we have the total sales, we pick the variable cost per unit. Variable cost per unit. Sorry. Per unit. And the variable cost per unit given to us there is just going to be 500. You can clearly see it, it's just given to us over here, 500. So we just pick it. Remember, we're just picking the values the way they are over in the base case. Enter. And you remember the variable cost component changed at this point. Remember, it changed at this point here where the variable cost was actually increasing at 5%. So it changed to 525. So we just move towards the right and then Control R. How about the total variable cost? So here, with your permission, I'll just move this a bit towards the right. Over here, I can say variable cost, total variable cost. Total variable cost. And the total variable cost will be given as variable cost in terms of shillings times the units. put towards the right, Control R, and it picks. Once we have the total variable cost, we can be able to pick now the sales in terms of the variable costs, the sales variable costs, so sales. Variable cost. Sales variable cost. And we can see that it is just going to be the total sales and then we add the total variable cost. That's what we are going to do. So it's going to be the sales, which is there. Then we add that value. But there's one thing. The variable cost is a cost. Please note. So what we're supposed to do is that we're supposed to put this in form of a negative sign there. So apologies for that. Put a negative. Put it like that. Then I move it towards the right there. So that now we can be able to indicate or be to show that it is actually indeed a cost. And so you can see the sales variable cost actually changes there. So now what is left is for me now to just drag it like so. Please note one thing, that the unit sales were given to us there. The selling price was also given to us there. The total sales is just the unit selling price times the unit sales. The variable cost per unit, we had already computed it right above over here, and we say that this variable cost component over here is going to change by an increase of 5% increase variable cost. The sales variable cost right over here is just given to us as the total sales minus variable cost. So the sales less variable cost gives us this value here. How about the fixed costs? The fixed cost is given to us there as follows. 5 million. It's right here. So we enter, and because we're saying it's a cost itself, so let's put a negative sign there to show that it's a cost. Then we move towards the right like that. Remember, the component of fixed cost over here changed, 5,250,000. So we're putting it a negative over here just to indicate that it's a cost. And with that, we can be able to then identify the cash flows. Cash flows. So the cash flows we have over here are just going to be 18 million, and then we subtract 5 million. Or we add. Why I'm adding is because we need to, is because we're going to subtract. Please note. So we're going to add. If I subtract, it's going to be 18 minus, which comes to plus. So I should be able to just add it right there. So get 13,000. 13 million, pardon me. So 13 million. Control R. Move towards the right. And those are the cash flows. But remember one thing, that there was a residual value over here that we didn't factor in. So we just put it in there. So the residual value year 5, so you can put it year 5 is a cash inflow. So how much? We pick those residual values from up above here, please. There. Then, because there's a change in residual value over here of 2.375, we need to factor that in. So control R, but we do not subtract it. It's a cash inflow. So then we are going to, or we'll need then to get the present value interest factor. So down over here we'll have PVIF, present value interest factor, year 1 times cash flow, times cash flow. Which cash flow? These ones here. So we'll do the same, PVIF year 2 times cash flow up to year 5. So year 1, year 2, so I'll just change this, it's going to be easier to change that. Year 3, year 4, then year 5. Cash flow there. And how do we get the present value interest factor? We're just getting the present value interest factor. Could put the interest rate right above over here. So interest rate, it's at 12%, all through 12%. So here we put that, and we 12%. So it's going to be plus the cash flow and then we discount, we are discounting it, discount it against, open the brackets, 1 plus that value, close the brackets, power 1 times, yeah, not times the cash flow, it's already been multiplied like that. So we enter. So once we have that, we shift, control R, that is year 1. Notice what I've done over here, you can see even the formula, it's power 1. So here I'll do power 2, power 3, power 4, and so on and so forth like that. So because I want the cash flows, it's going to be plus that value over 1 plus that one, power 2, that. Do the same thing. One plus R power 3 that. So here is going to be this power 3, yes, power 3. So power 4, sorry, I was just having some trouble with the mouse, sorry. So plus the cash flow over, open the brackets, 1 plus power 4, that, Then finally we have power 5, but we will also need to work out the residual value right here. So the residual value, then the cash flow is going to be plus that value over 1 plus power 5. Enter. So Control R. Then we have what is called the residual value. Residual value. So you can see PVIF, value interest factor, year 5 times cash flow. That's what you do. So this is residual value. I should change this to enter, just to do that. And we're saying that the residual value was what value? Residual value was that one over 1 plus that value power 5. Please note it's power 5 because there's a cash inflow that is coming in at the end of period 5. Just to confirm that it's okay. Yes, that's okay. So from there, we get the total PV. And I can just be able to indicate it using a bottom border, thick border, the bottom, thick border at the bottom there. You can see that we're getting the total present value. Present values is going to be those ones there, like that, up to there. Then I just drag it towards the right, Control R, it gets the total, and I bold that, Control B, as well as this one I Control B, like that, to show that that's the total present values. But remember, part A is requiring us to get the net present value. You can see here, compute the base net present value. So we need to deduct the initial cash outlays. So initial cost, we're saying plus, should I say plus or should I say minus? So say minus that value. The initial cost is there. So 40 million. Remember, the initial cost over here will change. This value here will change based on whatever we calculated over here. You can see it's 42 million. So we just change Control R, that, we get the NPV. Put it, Control B, then you put a top and bottom border, plus then it may not be very clear, so I put that thick border there, and then I put also this other border here with the permission. It's just presentation, good for presentation, characteristics of good financial models there. So with that, then we have the scenarios. Part B, carry out a sensitivity analysis for NPV assuming adverse variance of 5% for all inputs except project life and weighted average cost of capital there. So the base case, so we'll have, so part B, I can do it just down over here. So the base, we just almost like sort of copying this. Down over here. Then we have the NPVs down here, because we have the NPVs given to us over here, and net present values. NPV. NPVs. So just pick those ones. Then once you pick one, then you just drag it. With that, we can then just, now we've done that, carry out a sensitivity analysis, we've already done the sensitivity analysis, prepare an appropriate chart to indicate the different NPVs. So part A was to compute the base case NPV. We have already done that. The base case NPV is this. Then from there, we are told part B to carry out a sensitivity analysis of NPV, assuming adverse variance of 5% for all inputs except project life and weighted average cost of capital. Adverse effect. So the initial cost, initially, the initial cost was given to us over here as 40 million. So we've done an adverse, the opposite, the adverse, by increasing it of, or rather, by increasing it by 5%. So we've increased it by 5%. Here we've reduced the unit sales by 5%. The selling price we've reduced by 5%. So we're trying to answer part B, carrying out a sensitivity analysis assuming adverse variance of 5% for all inputs except project life and weighted average cost of capital. Yeah. So we cannot have an adverse effect for the initial cost. You cannot, unless the cost is an adverse effect, it means that the initial cost increases in value. That's what we mean. It cannot reduce. If the initial cost reduces, it means it's an advantage to us because we are spending less. You get the point? So the unit sales is now when you're getting a negative value over here. The unit sales decrease. The selling price also decreases here. The variable cost, because it's a cost. The only way a cost can be an adverse effect is if it increases. That's what you're saying. A fixed cost is, because it's a cost, if it increases is when it becomes an adverse effect. For residual value, becomes an effect when the value actually decreases. And that's why we are putting these values differently there. I hope that point is driven home. So with that, then I'll just go to part C here. So we've done a sensitivity analysis for the adverse effects of initial cost, selling price, fixed cost, variable cost, and residual value. And then we are told to prepare an appropriate chart to indicate the different NPVs, each scenario in B above. So what we'll do, we just go towards the right here. Towards the right. And we come and we move on to insert. Once we go to insert, we can come to recommended charts. Click on recommended charts. And you can see whichever chart pleases you, you can be able to recite it, so long as it yields whatever we actually need. So this one, maybe perhaps select this value here, this one. And we say, okay. So the different NPVs that, or the different sets of, or the adverse effects of those values, base case, are actually indicated to us over here. And this means that at the base case, we are actually over there. The initial cost sensitivity plus 5%, because it's a cost. Any cost should be, an adverse effect should actually increase or get a positive value. But any positive value or selling price or what we are selling should actually be indicated by a negative sign if it is going to be an adverse effect. So these are the NPVs based on the initial cost, the annual sales, selling price, the variable cost, and the fixed cost, as well as the residual value. So this, ladies and gentlemen, brings us to the end of question 22, business and data analytics. We hope that you have enjoyed being with Manifested Publishers. Thank you and God bless you. Hello learner, welcome to Manifested e-learning platform. My name is F.A.M. Lingwiri, and today, ladies and gentlemen, we are discussing about the business and data analytics, April 2023, question 22. It reads as follows: you work as a management accountant for Majani Limited, which deals in tea production and export. Before embarking on next year's budgeting, you are tasked with analyzing past revenue and price trends. As a starting point, your supervisor has provided you with historical price and production data as shown in the worksheet. So you can see the dates have been given to you, the production, millions of kilograms, prices per kilogram. We move down and see what we are required to do. A, plot a line graph for price against time or dates. Insert a linear trend line displaying the equation and R squared on the chart. Briefly discuss your results. So we go back up here and pick the relevant data. We start with the dates, move down like so. Then we go back up again and pick the prices. But before we pick the prices, we need to press Control so that now it can jointly pick the dates and the prices at the same time. So you can see as I press Control. Then you hover around Insert, click on Insert. Then you come to Line Chart. This is what to say the line chart. So you click on it. Then you proceed on to click whichever chart pleases you amongst this list of for line charts. So let me click on the first one. So as you click on the first one there, we just need to just be patient a bit so that now the output like so can actually come out. So what we do, we just place this where it's supposed to actually be, next to the solution, ladies and gentlemen, there. And moving like so would mean that we would be able just to place the data where it is actually supposed to be, which is right over here. So what are we told? We are told that we need then to plot the line graph. That's okay, we've done that. Insert a linear trend line displaying the equation and R squared. So we need to display the equation and R squared. R squared represents the coefficient of determination. Coefficient of determination assists the investment expert or the accountant to identify whether the regression is reliable. So we go back up here and we just right click on the graph. We add a trend line right here, and when we click on this like that, the trend line should be able to appear. As you can see, moving towards the right here, the trend line appears. We can then now display the equation. So you can see all of these inputs over here. There's either exponential, there's linear. Linear is what we've been told that we need to do. The trend name, we just say it is the linear price per kg, which is okay. Then we move ahead and say that we need to display the equation, which is there. We tick that. And then we also display the R squared over here. So we tick that. That's what we've been told by the examiner. And then we can close this part here, close it. And for a clearer picture, we can place the equation just above there like that. And then also what is going to appear is going to be the r squared. Now that's much clearer as compared to where it was initially placed right there. So this is our part A. We can then move ahead and try and identify what we've been asked for part B. For part B, we are told, using a suitable MS Excel function, show that the coefficients shown in the trend line in A above are in fact a result of a linear estimation between historical prices and time. So what we do is that there is what is called a leanest function over here. So we move this over here like this. Say this is part A. Like that. So you can put over here part B. And we now use the leanest function plus leanest. So what is leanest? We are saying that the leanest represents linear estimation in full, and this value returns the statistic as it's shown over here. It returns the statistics that describe a linear trend matching known data points by fitting a straight line using least squares method. So what we do is that we then now need to identify what our y value is. Our y value represents the prices per kg. So come over here and highlight everything there for known y's. That. And then we go back up. Our known x's. Our x's are influenced, are the what we call the independent variables. They're the ones that influence the y's, saying that the dates and the production in kgs, we highlight both of them together like so. And then clicking on this part over here called constant here, it represents a logical value. And we say true over here. True. That. And we say okay. So we are told that an unexpected error occurred. So we just click OK here because we are saying that we are getting negative 0.74. And this is the formula for the linear estimation. So linear estimation right here. And we say leanest. Like so. Leanest. We can be able to put it like so. And put it in form of maybe say perhaps we can be able to just highlight maybe in a different color and maybe just for presentation purposes there. So you can put it like so. Then maybe you can proceed on to put it in form of a thick square outside there. So we expect that this 0.7412 should actually be the same as the value right over there from the equation. So moving on, we can then move on to part C. Part C, you can see that you know that prices are affected by production. Because of this, you would like to run a regression between price, production, and time. Use data analysis toolpack to run the regression analysis, interpret your results. Be sure to discuss the coefficients and the parameters. So what we do is that we run a regression, part C here. Like so. And then we pick the dependent and the independent variable. So the data analysis toolpack is under the data tab here. Click on data. Then on the far right, you can see data analysis. Click on data analysis. And then you search for regression right here. You can see regression is right there. Click OK. What is our Y input range? The prices. So we click the prices like so. And then our X input, click there. We go back up again, and we can see that both the dates, this is a multiple linear regression, the dates and the production levels are the ones that influence prices. That. So if perhaps you would want the labels, be able to put in labels over there like that, and then we click OK. So we have this output. So you can copy this output right over here and place it as appropriate on question 22 right under part C here. Control V. And we are saying that we can be able to see these regression statistics, R squared, which represents coefficient of determination. The standard error has also been given. We also have number of observations, so 154. That. And here is what we have as the intercept right here. We have the intercepts right over here. Then we have the dates over here. So you can change this to dates. And here you can be able to say production and millions per kgs production. Kgs. That. When x is 0, what is the value of y? Then that's what is represented by the intercept there. The dates are coefficients that influence the prices, the dates as well as the production in terms of kg. So we are saying that you can see this is the intercept, the date and the production per kg. That. Notice that under leanest over here, we expect negative 0.074. That. So 0.074 should be the part of the intercept right there. We can now move on and understand or analyze the p-values here. Come to home and we come like so, we do like so. We are saying that low p-values less than 0.05 means that the coefficient is likely not to equal 0. But if we have high p-values greater than 0.05, then we are saying that we cannot conclude that the explanatory variables actually affect the dependent variable. In terms of the F statistic over here, we need to look at the F statistic in collaboration with the p-values. The F statistic, or rather, when you're saying that because the p-values over here are greater than 0.05, with the exception of this production of kgs, then the model might not be reliable for analysis, or might not be used for analysis. When we look at the R squared, our R squared is given to us right over here. I can highlight that one over there. And we're saying that we want our R squared, if R squared is greater than 0.95, then the regression should actually be reliable. In our case over here, it is not greater than 0.95, and hence the model is not reliable for analysis. It cannot be used to predict the future production levels. So what can we conclude from that analysis? We can conclude that the model is not good. because we are saying that the R squared is not greater than 0.95. Secondly, we are also saying that the P values right over here, because most of them are actually greater than, all of them are actually greater than 0.05, all of them 0.05, we are saying that we cannot conclude that the explanatory variables actually affect the dependent variable. We can also conclude that innovations can be, for example, to remove this constant value over here, to try and evaluate and estimate if the value is okay, or we can be able to use other metrics or other time series data to analyze or make inferences of this data that we're analyzing towards our left. So that is it for question 22. We hope that you have enjoyed it and you've understood how to run a regression. Thank you for being with Manifested Publishers. Be blessed.
Hello learners, welcome to Manifested Publishers e-learning portal. My name is Celestine Wandabusi. In our today's session, we are looking at a revision of Management Accounting April 2022. I just urge you to follow closely. Make sure you have your calculator with you so that we move together. Welcome. So I'm beginning with question number 1, part A. The question reads, cost accounting uses information provided by financial accounting together with other details of internal operations of an organization. With the reference to the above statement, describe 3 similarities between cost accounting and financial accounting. So we want to look at what are the similarities between cost accounting and management accounting. Number 1, we have periodicity of reporting. 2, accuracy is maintained in both systems. 3, the results of the business is revealed in both systems. 4, vouchers and we have vouchers and invoices forms the basis for recording of transactions, for recording business transactions. Number 5, we have fundamental principles of double entry is maintained in both systems. So these are some of the similarities between cost accounting and financial accounting. We have periodicity of reporting. In cost accounting, periodicity is more frequent than in financial accounting, where in financial accounting we have reporting done either semi-annually or yearly. But in cost accounting, it may be done weekly, monthly, or on yearly basis. But in both systems, we have that periodicity of reporting. Then we have accuracy of accounts being maintained. In both systems, we ensure that there is no biasness, there are no mistakes, errors, or omissions. So accuracy is maintained in both systems. Then number 3, we have results of the business revealed. The intention is simply to know whether there is any profit or loss being made, or to know the financial position of the business. And therefore, in both systems, we have results of the business being revealed. Note number 4, vouchers and invoices form the basis for recording of business transactions. They form as part of the books of original books of subsidiary entries, which help in like creation of any other account. So we apply that in both systems. Number 5, we have fundamental principles of double entry. Whenever we are passing entries in both systems, double entry principle must be applied. So those are the similarities in the two systems. We move on to part B of the question. We are told that Rengo Limited has provided the following data for the financial year 2022. Number 1, we have budgeted output for the year, which was 9,800 units. Note 2, we have standard details for 1 unit. Under that, we have direct materials, we have direct labor costs. We've been given variable overheads and fixed overheads. So required, prepare a standard cost statement of unit cost showing prime cost, Roman 2, variable production cost, Roman number 3, total cost, and Roman number 4, selling price per unit at a notion profit of 15% on cost. For you to be able to answer this question, you need to understand what you need to consider, especially pertaining the data that you've been provided with. The question requires you to compute the total cost, but in that total cost, you need to show the subtitles. Prime cost, show the variable production cost, the total cost, and the latter show the selling price. So the best way of answering this question is simply preparing what we refer to as the cost sheet, which will enable you to show all the costs incurred, get the total cost, and then show the selling price. So this will be computed as follows. This is Rengo Limited. Note number 2, we are told that standard details for 1 unit, direct materials is 4 square meters at 530. So to know the amount for that particular, for the raw materials, we are simply taking that quantity and then you multiply by the price. So we'll have 40 meters times the price, which is 250, which gives us 10,000. Then we have direct labor. We are told this was incurred in 2 departments, so we have bonding cost center. The quantity is 48 hours. You multiply by the price per hour, which is 250. Sorry, this should be 530, not 250, 530. So we calculate this. This should be 21,200. This is 12,000. Still under direct labor, we also had another department which is finishing. Finishing cost center. The hours used were 30 hours and the price per hour is 190. So you simply multiply 30 hours times 190. Which will give us 5,700. So add this. This is 17,700. In our part 1, we were required to show the prime cost. You now show the prime cost. Prime cost is simply the total of direct materials, direct labor, and direct expenses. So since we do not have direct expenses, the total prime cost will simply be direct materials plus direct labor. So this will amount to 38,900. So you've already answered part 1. In Roman number 2, you are told to calculate the variable production cost. So we now calculate variable production cost. When you look at note number 3, we are told that budgeted costs and hours per annum. Variable overhead, you've been given hours, and then we have shillings. So we have bonding cost center. Hours were 500,000, and the amount is 3,750,000. So we have not been given the cost per unit. For you to calculate the cost per unit, we do what we refer to as calculation of an absorption rate, which is simply based on the cost that is given divided by the number of hours that have been given, and that will give you the cost per unit. And therefore, in the bonding cost center, to calculate the cost per unit, you are simply taking 3,750,000. Then you divide that by 500 hours. You divide that by 500,000 hours. And then we were told that it is related to direct labor. So the direct labor hours that were incurred in the bonding cost center were 48 hours. So once you get the cost per unit, you now multiply by the number of hours that were incurred in that particular department. And this will give us the cost per unit for that center. So when you calculate you'll get 360. You do the same for finishing cost center. For cost finishing, we have 1,500,000 shillings. We are dividing by 300 hours to get the cost per unit. Then you multiply by the number of hours that were incurred in the finishing department, which was 30 hours. This will give us 150. Then you get the total. And this is 510. And that's part 2 or Roman 2 of that question, variable production cost. Then we move on to Roman 3. We are to compute the total cost. Still on that note number 3, we were given fixed overheads. So we are to calculate the fixed overheads. And under the fixed overheads, we've been given the amount for production. And remember, in note number 1, we were told that budgeted output for the year was 9,800 units. So to get the cost per unit, you are to take the production amount of 39,200,000. Divide this by the number of units that were produced, which is 9,800 units. Then multiply that. Sorry, we don't need to multiply, and get the cost per unit. So calculate that. This will give us 4,000 shillings. We also have selling and distribution, fixed overheads, and the amount is 19,600,000. Divide this by the number of units that were produced, which is 9,800 units. Then divide that. So this will give us 2,000. And then lastly, we have administration. Administration overheads, the amount is 9,800,000 divided by the units of output to get the cost per unit. And this will give us 1,000. Then get the total, which will give us the total cost. So we are adding from 38,900 plus 510 plus 4 plus 5,000 plus 5,000, which will give us 44,410. So that is the total cost. In Roman number 4, the question requires us to calculate the selling price per unit at a notional profit of 15% of cost. 15% of cost. So we already have the total cost of 44,410. We need to calculate profit, which we are told it is 15% of the cost. So calculate 15% of 44,410, which will give you 6,662. And then from there we now get the selling price, which is now the total of the cost plus the profit. And this will give us 51,071.5. This will be the selling price. So that's how you want to answer part B of question number 1. We proceed on to Roman number, to part C of the same question. We are told that Jumbo Limited manufactures bracelets for export trade. The sales revenue is dependent on level of advertising expenditure per month. The company has recorded the following sales information for the past 6 months. So we've been given the information about advertising expenditure and sales revenue. And then we are told that the following has been calculated. So you don't need to calculate, the figures have already been given. Then required, estimate fixed and variable elements of the sales revenue using the least square regression analysis. To use least square regression analysis, you need to know how to determine the values of A and B. And therefore we have a formula which we use to calculate the values of A and B. So the regression formula is as follows. Sum of y equals NA plus B sum of x, and sum of xy equals A sum of x plus B sum of x squared. So these are simultaneous equations which must be solved together, and the intention is simply to find the values of A and B. So we have already been given information. We are told in that question that sales revenue is dependent on the level of advertising. Whenever you are answering this question, always be able to identify the independent and dependent variable. So the question has already interpreted for you what is the dependent variable and what is the independent variable. We have advertising expenditure and sales revenue. you've been told that sales revenue is dependent, meaning the sales revenue is our Y variable, which is the dependent variable, and advertisement is the X variable, which is the independent variable. Under that table, you've been given the values. So what we need is sum of Y. Remember, we are saying that sales revenue is the dependent variable, and dependent variable is abbreviated by Y. So sum of sales revenue is given as 192,000. So just reduce the zeros based on the table that we've been given above. So we'll have 192 shillings equal to, N is referring to the number of observations or items that we have, which are already listed, and there are 6. So we have 6A plus sum of X. What is the sum of X? X is referring to independent variable, which is advertisement. You are given sum of advertising expenditure, which is 13.5. 13.5B. So this will become our first equation. Then we move on to equation number 2. We have XY, which is referring to advertising expenditure times the sales revenue, which again we've already been given. So this is 147,000.25 equals sum of X, that is sum of advertisement, is 13.5A plus sum of X squared, that is advertisement expenditure squared, which is 32.125B. And this will become our second equation. So from there, we solve the equation simultaneously. We want to eliminate A. So to eliminate A, we must make values at A equal. To make equal, simply cross multiply. We have line 1 being multiplied by 13.5, multiply line 2 by 6. And remember that 6 and 13.5 is affecting all other values. So you multiply 192 times 13.5, which will give us 2,592. These are shillings, equals 6 multiplied by 13.5. This is 81A plus 13.5 squared. This is 182.25B. Do the same for the second line. We are multiplying all the figures by 6. So 147.25 times 6. This is 883.5, which will equal to 13.5 times 6 will give us 81A plus times 6. So this times this will give us 192.75B. Then you subtract. We are using elimination method. Subtract the values. So we are using elimination method. This should be 447, not 147. So 447.25 multiplied by 6 gives us 2,684. So we then subtract the figures. 2592 minus 2684. This will give us negative 92, which will be equal to, this is a 0. Then 182.25 minus 192.75. will give us negative 10.5b. From there, our intention is to find the value of b, so we divide both sides by negative 10.5, divide both sides by negative 10.5. So b will be equal to it will be equal to 8.76. 8.76. So once we find the value of b, we now use that to calculate the value of a. So regression analysis equation is in the form of y equals a plus bx. And so for us to find this a, we are to use the first equation because it has smaller figures. So we'll have 192 equals 6a plus 13.5. We already have the value of b, replace that with 8.76. Then you solve it. So we have 192 minus 118.25 equals 6a. So 73.74 equals 6a. Then we divide both sides by 6. Therefore, a will be equal to 12.29. And that is the value of a. So the question simply required us to find the value of fixed and variable elements of the sales revenue. So what are the fixed? In this equation, y equals a plus bx. A is referring to the constant, which is the fixed cost, and b is the variable cost. So we've already calculated the value of a and the value of b. So b is the variable cost and a is the b is the variable cost per unit and a is the fixed cost, and that is what was required in that question. Thank you and bye bye.
Hello and welcome back to the lesson. The subject is leadership and management. Today we want to answer question number 4. Question number 4. Part A reads, examine 3 skills required by managers at different levels of management. 6 marks. Skills required by different managers. Part A, skills required by different managers. At different levels of management. Now, what is a skill? A skill is the ability to do something proficiently. And managers at all levels are required to possess certain skills in order for them to carry out their functions. The first category or the first skill is known as technical skills. Technical skills. Now, technical skills, we can say, is the ability to use specific knowledge, methods, techniques, processes, procedures, and resources in performing work Do you understand? To have technical skills is to have the ability to use specific knowledge or methods or techniques in performing work. For example, if you are an accountant, for you to carry out accounting work, you require accounting skills. If you are a video editor, for you to carry out video editing function, you need to have video editing skills. If you are a preacher, for you to preach, you need preaching skills. If you are a farmer or a carpenter or a teacher, you require to have specific knowledge, specific methods, specific techniques, specific processes and procedures in performing work. They are technical, and these skills are especially important at the first line management level. Why? Because daily work related problems must be solved. So a manager who supervises accountants, a manager who supervises builders, one who supervises carpenters, such a manager requires to have the specific skills. If you are supervising video editors, then you require to have video editing skills. Otherwise, what would you be supervising? So these are skills that are required at the lower level or the first line management level. That should be clear. Technical skills. Then the second skill is known as analytical skills. Analytical skills involve using scientific approaches or techniques to solve managerial problems. It is the ability to diagnose and evaluate in order to identify key factors and to understand how they interrelate and the roles that they play in a given situation. And for a manager to understand a problem, the manager has to possess analytical skills, or the manager has to have these skills in order to understand a problem. So the manager will use analytical skills in evaluating a situation, in finding out what are the causes of the problem, and also in putting in place all the factors that surround the problem, so that the manager can not only just understand the problem, but also can develop a plan of action. And without analytical expertise, there is little hope for long-term success of any company. 3, decision-making skills. In this subject, we covered decision-making skills. We learned that decision-making is very important almost at all levels of management. A manager must make decisions. A manager is forced in most cases to choose among alternatives. And the quality of decisions determine degree of effectiveness. So a manager's decision-making skill in selecting a course of action is influenced by his analytical skills. So poor analytical skills are bound to result in inefficient or inadequate or in erroneous decisions. Decision-making skills. Lower level managers need these skills. upper level managers need these skills, middle level managers need decision making skills. And even to some extent, employees, the subordinates, they require to have decision making skills because we solve problems by making decisions. For human relations skills. Human relations skills. The human relations skill is essential at every level of management within an organization because it is a reflection of a manager's leadership abilities. Whether is a lower level manager or a middle level manager or an upper level manager, these managers interact with the employees, they interact within themselves, they interact with the shareholders, they interact with the suppliers, you interact with the customers, you interact with the visitors, you interact with the officials of the government, you interact with all the stakeholders. So these skills are relevant at all levels of management. And the ability of managers to work with and communicate with others is very important. Very important. Human relations. So these are social skills. Social skills. Then number 5, communication skills. Communication skills. These skills are also needed or required at all levels of management. Effective communication, whether it is written communication or oral communication, is vital for effective managerial performance. Communication skills involves the ability to communicate in ways that employees understand in order to seek and use feedback from employees to ensure that one is understood. And this skill is critical for success in every field. But it is crucial to managers who have, who must achieve results through efforts of others. Management, we know, is getting things done through others' effort. So if you are to get work done through others, people's effort, then you need to possess communication skills because others need to understand what you need. You also need to get feedback from them. So it's a very critical for every manager to have communication skills. 6, conceptual skills. Conceptual skills consist of the ability to see the bigger picture. His ability to see the complexities of the overall organization and how the various parts fit together. And the importance of knowing each part of the organization and how it interrelates with the other parts contributes to the overall objectives of the organization. Conceptual. To conceptualize, to see the bigger picture. This skill is vital or necessary at the upper level management. Conceptual skills. The ability to do what? To see the bigger picture. The ability to see the complexities of the overall organization. Not just the internal environment, but also the external environment. The ability to see the impact of the various factors in the external environment. That's conceptual skills. I've discussed 6. You are to discuss 3 to earn 6 marks. 1, 2, 3, 4, 5, 6. Any 3, 6 marks. I now want to answer part B. A leader's primary responsibility involves accomplishing the tasks for which the group or an organization exists. With reference to the above statement, identify 5 methods that a leader may employ toward achieving the desired results. I'll use this space here, B. Methods that a leader may employ. Methods that a leader would employ to achieve the intended result. The first method will be in relation to the leadership style. The leader's leadership style. Now, the leader should use a style that suits the organizational culture. Implementing a leadership style that suits the organizational culture can encourage employees to be motivated. Why? Because they will consider their leader as someone who is able to give inspiration in doing organizational jobs. Leadership style. We have various styles of leadership. We have the democratic style, the laissez-faire style, there is the authoritarian style, and so on. So if the organization, the culture of the organization is one that supports laissez-faire, that is the free style, then the leader should adopt the laissez-faire style of leadership in leading the organizational members. But if the leaders, if the employees prefer the laissez-faire style, if they've been used to being led in such a way that they're given freedom to choose what time to work, to choose what, to set their own objectives, and then a leader comes in with an autocratic style of leadership, then that can that can discourage employees, that can demotivate employees, because they will consider their leader as someone who is unable to inspire them towards achieving the intended results. Leadership style. A leader can also achieve the intended results through coordination. Coordination. That is, organizing organizational members by coordinating all parties within the organization. That is one of the ways for a leader to achieve organizational goals. If a task is to be achieved, for example, if a company's objective is to produce, say, 10,000 units in a given accounting period, then the leader has to coordinate all the activities that are involved in the process of converting raw materials to the 10,000 units. All the work that is required, right from purchasing of raw materials, from inspecting the materials that have been received to check if they are of the right quality, of managing inventory of raw materials, of the process of manufacturing, that is production, the production department, ensuring that the machines are well maintained, ensuring that the products are produced according to the processes or procedures that have been put in place, having controls to ensure that there is clear adherence to the procedures to convert the raw materials into finished products, right through the storage of the finished products, the selling of the products, and all those activities involved require coordination. The recruiting of staff competent enough to help in the process of achieving the intended result. The intended result could be what I've just said, production of, say, 10,000 units in a year. So it requires coordination, proper coordination. Do you understand? Yes. There is proper coordination. That is organizing the organization of members by coordinating all the parts within the organization. Is one of ways in which a leader can achieve the intended results. The third method is motivation. Motivation. A leader does not do the actual work. A leader influences the employees to perform certain functions or jobs, or to achieve the intended results or the desired